many ways to structure a deal. So, and once again, to the same point, it's getting creative. If you're going through a deal and you're getting hung up on a way to make it work, or you're going to raise capital and you're getting hung up on a way to make it work, it is figuring out a different way to structure to make that work. Right? There's tons of different options, tons of different avenues. It is now introducing you to some of this. Okay.
I think to that point too, and Tyler always says, we don't teach you guys stuff that we haven't learned, right? Or that we haven't done. It's interesting. We use capital stacking or different preferred returns. There's reasons why we do different preferred returns, and Tyler will talk about that later. But some of it is urgency. Of getting your high net worth individuals to put their money in quicker at a quicker rate. So we did that about a year and a half ago or so, and started doing that about a year ago maybe. With the 7 and 8% different preferred returns, and you see investors just putting their money in so much quicker. So there's creative ways to do it to get your investors to invest faster.
For sure. Okay, so let's talk about some of this. Okay, so there are 6 main components when we're going to be talking about deal structuring. Okay, we have the entity structures, the different entities that we set up, and we'll talk about what our preferred choice is and what we do 99.9% of the time. We have the waterfall components. We have, we'll also talk within the waterfall components. We'll also talk about the capital stack, which is just essentially where's the money coming from and in order of priority. The return of capital, your equity returns, right? How those are, different ways to structure those. And once again, there's a million ways to structure. We're going to be talking about the most common, and then obviously doubling down on what most of us will use and the different ways to go about it. Control and voting rights, how those works. It's a pretty simple section there. Then you have your different equity groups that you can use. Then we have some sponsor fees, right? How we get paid. Okay, so let's dive into some of this, okay? Maybe, there we go. Okay, our entity structures. These are the 3 most common entity types, right? So you have your REITs, right? I think I control it. Perfect. You have your REITs. You have your LLCs. I don't even need to freaking have this thing because I'm right here. I can just point it out here, okay? Your REITs, your real estate investment trust. You have your LLCs, your limited liability companies. This is, once again, that's our bread and butter. That's our go-to. And then our limited partners, we call those our limited partnerships. Sorry, we call that an LP. Now, explain a REIT for me, if you will. Throw that one on your shoulders.
Or institutional money, right?
Well, yeah, it's a fund.
Yeah, it's a fund. So, they're, my goodness. That's early in the morning.
Do you want to know why I threw that on his shoulders, REITs? Because we never structured through a REIT. So I was like, hey, man, you take that one. Okay, I'll take the rest because it's easier. But, okay, a REIT, real estate investment trust, have for a very long time have been, a way to put together large real estate portfolios, right? They can be publicly traded, privately traded. Most of the stuff that we do would be privately traded. A trust, that can be a fund. It can be a fund of funds. There's a number of different ways to go about that. They can also be organized as corporations as well. So the most... Oh, I see one of the questions. Do you start getting creative after PSA or during underwriting to evaluating a deal? So the question from Brett, do you start getting creative after the PSA or during underwriting? Yes and yes. It depends. It's preferable that you get that done during the underwriting stage because your numbers are going to be different depending on how you structure, right? But we got into a situation once where we went in with thinking that we were going to do a syndication, and throughout the as we were going through the equity raise, we realized it'd be easier to bring in one big group to cover the entirety of the raise, and so then we got creative to restructure and rerun the numbers to make that happen. When I look at a REIT, I look at more of like a fund and how we structure a fund. And a fund is these investors are going to come in, and it is different, but I want to kind of cover this breakdown. With a fund, instead of an investor coming in and investing into a specific property, they're investing into the fund, right? And that fund then goes out and purchases these different properties, or invests, I guess is the best way to say, in these different properties. So, for example, there's what's called a fund of funds, right? And a fund of funds would work like this. Let's say that Ryan and I are going to raise money from y'all, but we don't have deals, to a specific deal to put your investments in. And let's say that we're not good operators anyway. We're just good at raising funds, and we know how to identify good operators. Okay, what we would do is we would have all of y'all invest in this fund, and it would be considered a fund of funds, because what we're going to do is we're going to take that and we're going to invest in other operators' deals, and we're going to get a cut for doing that, right? So in the fund, for an example, let's say that we would own 20% and our investors would own 80% of the fund, and then that fund would go and invest into a deal. Okay, well, let's say that deal makes, for an example, let's say 10% returns, just to keep it very simple, easy math. 10% returns in that fund, which, in that investment, which should be more than that, but 10%, let's say that to make it easy. Well, that 10% would be paid to the fund. And then if we own 20% and our investors own 80%, then we would get 2% of that money, and our investors would get the remaining, or we'd get 20% of that money, the investors would get the remaining 80, right? So there's different ways to structure a fund of funds, and that's the cool part about that is because you're bringing in such a large amount into the deal, if you structure that way, you can negotiate higher returns, right? So instead of an 8% preferred return, and we'll talk about preferred returns and different, these different components, but maybe because you're bringing in such a large amount, you can negotiate a higher return than just an 8, right? Maybe you get a 10 or maybe you get a 12, and now it filters down into your investors in that group, still make what they would make if they were to invest specifically into the property, but they are now able to do that and diversify over multiple assets. So there's different ways to structure. Now, a limited partnership would be more if you, let's say you were going to bring in, one investing group, right? One big group that's going to cover the entirety of the raise, and now it's going to be like a joint venture. You have limited partners, that's more your investors. And then you have some joint ventures as well, which would be you and your investors make the managing decisions. But with an LLC, which is what most of us structure with, how does that work?
So typically you're gonna have your LP sides, GP sides, and you're gonna bring those in on an LLC. So a lot of people.
So let's break down some terms though.
Okay.
LPs, type it in the chat. What does LP stand for? What does LPs stand for? Brett, I'll answer that question in just 1 second. There we go. Limited partner. Now, what does GPs stand for? General partners. Now,
And they're quick, man. They're quick at responding.
quick typers, right? Brett says, which team member helps to evaluate and structure these deal structures? All of us, man. I mean, all of us. When we're getting into a deal and we're trying to figure out how to structure, it's just getting creative. And let's say that we need to course correct. We've already got the PSA signed. We're starting to do our raise, and we need to course correct. We get together as a team to determine the best way to approach it. The best way to approach it, hey, we can structure it this way with one investor and do this waterfall return, which I'll break down waterfalls and all that kind of stuff. We can do this. It's all of us getting together, putting our heads together and figuring it out. But I want to cover some terms real quick. General partners, that's what y'all are, right? You are trying to be the active investors on a deal. Your limited partners, right? That's your equity investors. They are usually passive on a deal. You'll also hear me call or say sponsors probably. And we'll kind of use sponsors and GPs or general partners. We're going to use that. Those are going to be interchanged. Man, we use them the exact same. A sponsor is a general partner is a sponsor. Just think about that the same way. Okay, now LLCs, give them the details.
Yeah, so hang on, I want to answer Tom's question really quick. That's a great question. So I think he was a little confused on the fund of funds of asking for a little bit more of a return. So 6 to 8%, you said 10%. Under the impression of 16 to 22%. So a fund of a fund works a little differently, right? So right now we have some partners that want to bring some money into a deal. So it is they have a fund of a fund. Anyway, they give their investors 12%, and that's it, 12%. So a fund of a fund works a little bit differently. We can actually send an article, Tom, out that would maybe explain it a little bit better than doing it on this call.
Yeah. So first, I mean, the most basic answer to that, Tom, I was just giving an example for easy math of the 10% return, just the easy math. But understand there's also a ton of different ways to pay investors, right? We all think that everyone's looking for a higher return. It's not necessarily the case. Some people just want cash flow. And so if you give them a higher cash flow return, then they don't participate in any equity. And I'll cover this in just a second. There's other investors who want to participate in cash flow and equity. And then there's other investors who just want to participate in the debt side, lower return, right? They protect their downside, but they limit their upside. So this is kind of my point, is there's a bunch of ways to structure. The most common is the 16 to 22% returns that we typically project through a syndication model with an LLC structure, right? Very, very common. But once again, there's never just this standard and this is how you do it, right? There's a million different ways to structure. That's the whole point of this class, is to help you understand that. But how do we structure? We determine what our investors are looking for. If we can truly dial in and determine what our investors are looking for, then we can figure out how to structure. But then with anything, we have to make a choice and move forward, right, to attract those investors. So we're going to dive into LLCs a little bit, because LLCs are, our entity, of choice. What we typically do, we have, we have the LLC, and then we also have, a holding company. The holding company is usually registered, within Delaware or Nevada, and I'll give you a breakdown here. There's other states that you can certainly register those in. That's usually what ours are, right? And then you have the local entity, also called the single purpose entity, the borrowing entity, the purchasing entity. Those are all interchangeable, and that's usually in the state where the property is located. And I'll show you this breakdown here in a second. But essentially, the local entity or the single purpose entity owns the building itself, right? And then the holding company is what owns shares within that LLC. Okay, so I'm going to break this down for you. Let's break this down here. And if you've ever been to one of my classes before, I typically show some sort of organizational chart. And I created this slide and then tested it. And I'm going to tell you, I already know that it's super fuzzy, it's super grainy, it's super hard to see on your end. I just didn't have time to change it after testing it. So this is my bad. But Jackson, give him the good news.
Good news is, as per usual, this will be uploaded to the path and sent out first thing Monday morning to everybody.
So don't stress, okay?
Yeah.
I really apologize. I am trying to figure out color schemes and what makes it fuzzy or not, and it is a never-ending learning process. You know, I have two people that we just hired. Their names are Max and Whitney. They are absolute rock stars. They'll be out here in my Maui office, and their whole job is to help me record and help lighting and help me figure out what the hell I am doing out here. Okay, recording and lighting. I don't know how to set that stuff up. For crying out loud, Ryan definitely doesn't know how to set this stuff up. I'm trying to set up lighting in here, and he's.
I think they would agree it's a bit of an improvement from last time, though. So that's a good point. You know.
All right, so we have the property. Okay, this example: 1, 2, 3, 4 Cedars Drive. That's the actual property, right? Now we have the single-purpose entity, which is really the borrowing group, the purchasing group that owns this property. Right? So this would be Cedars Equity Group LLC, as an example.
That sounds familiar. Why does that sound familiar?
Cedars is one of our.
Oh, jeez, that's one we just sold. Wait, hang on. What were the returns on that?
You tell me, man.
137.5% return to investors after 2 years.
Span, not too bad.
Oh, not
Lisa,
too bad.
Shout out to Lisa and Greg if they're on here. I did see Lisa say something about kava, but she spelled kava wrong, so it took me about 5 minutes to understand what she was saying, but I finally got it.
I think she had the hangover last night.
Lisa and Greg are actually out here right now too. So it's been very fun to have Ryan out here and Lisa and Greg out here, which are our partners out in the Carolinas and now in Texas as well. Okay, but this is the single purpose entity, right? That owns the property. Now you have different groups here. Okay, you have Class A members, Class B members in this example, and then you have the managing entity. That's the managing partners, which is what y'all are, right? The GPs. Okay. In this example that we have Class A members that own 70% of the single purpose entity. This is your limited partners, LPs, also known as equity partners. Okay. You have the Class B members. Who are the Class B members? Anybody remember? That ownership, that 30%?
Yeah.
That's y'all. Now they're not so quick on typing.
Not quick on typing.
That's y'all. That's us, right? So in this example, this would be a 30% carve out. We as sponsors, right, general partners would own 30%. Our investors would own 70%. But there's also what you haven't heard me talk about at a class, and if you've ever went through the SEC structure, you know, with the SEC attorney, with Bethany, with anybody, you realize that it gets a little bit more complex at this point, which is then there's a managing entity. So the managing entity is where all the voting would be done, all the management decisions would be done. And they're considered a non-member manager. That's what that's considered, a non-member manager.
That's where are you going to get into acquisition fees, asset management fees, or no?
Yeah, totally.
That's where all that gets paid out, right?
So explain that.
So on the management entity, right, is there's a couple different ways. So, you know, you can put it in the typing if you want. Do you guys like to pay taxes? Clearly not, right? Like no one likes to pay taxes. This is why it's so important to set this up correctly. I've seen so many people, I know you have as well, is they go, man, like in Florida, it's what, $135 or something like that to create an entity. They don't want to go to an SEC attorney or anyone else. They don't want to set it up, and they get hit with taxes, right? You know, and so it's important to know on your managing entity that your asset management fees and your acquisition fees go through there. Now, do y'all remember what an asset management fee is?
Type it in the chat if you remember. We're going to cover it if you don't, but type it in just in case.
So that's as you're typing, I'll explain it. This is the way that we get paid for overseeing the property.
Hold on.
Wait. Oh, is that?
You can't give away the answer.
Can't give away the answer. Okay, go ahead, type it in anyway.
We got to make these guys. We got to make
What,
these guys.
2%? I like Brett there.
Brett
Yeah.
Davenport, freaking killing it. 2% of dealing with the property managers.
I love how dealing with them, right? I love dealing with them. I love it, Brett.
I love it. Brett, I think this is the first time that I've been on a call that you haven't had your camera on, man. I want to see that smiling face. Both you and Megan. In fact, you know what? Y'all need to be better at turning your cameras on, but some of y'all need to be better at turning your cameras. Oh, there he is. What up, BD?
Some of us are working in the garage while we're listening to you. So I'm trying to get this train wreck squared away. So apologize.
All right, you're off the hook then. You're off the hook. It's funny because what's up, Nina? Some of y'all need to be better at turning your cameras on, and some of you need to be better at turning your cameras off. I remember one of the first Zoom classes that I ever taught. We got a guy eating a bowl of cereal. Just see this, his shirt off. Just see this.
That was great.
Here.
I do remember that. That was fun.
Right?
Oh boy.
Okay, explain that. All those fees that we just talked about.
Yeah.
Asset management fee that it's an actual expense line item on the property, right?
Yeah.
That is typically 1% of the collective rent. We'll talk about this later too. That gets paid out actually to here, right?
Yeah.
As well as your acquisition fees gets paid out here. Why is that important?
Why is it important? I mean, we want to separate those out, right? I mean, those are managing entities. You know, your holding entities, your Class B area where he's talking about is that's the percent ownership that we have in the property. Now, here's what's important. I see a lot of times, you know, SEC attorneys are going to tell you what you need to know. And a lot of times you see a lot of people go out, investors do what they want to do, right? They're only going to do, attorneys are only going to do what you tell them to do. They can give whatever suggestions that they want, but you know, I mean, we follow. I mean, we've done a lot of studying. I mean, Bethany's phenomenal. telling us what to do. But I've seen people, they go out and they put their holding company into a different state, maybe not Nevada. We do ours in Florida. Why? There's no state taxes there. We don't have to pay taxes on what we make. So think about when you sell a property, 137% returns. That's a lot of money you have to pay taxes on eventually, right? And so when you go to pay those taxes, let's say that you don't roll it over and you don't do a 1031 exchange. Well, there's capital gains. There's other taxes we have to pay, right? So it's important to put your, talk to an attorney on that. Bethany is phenomenal. We use her. You can use whoever you want, but we use Bethany with Premier Law Group. But it's important to follow their direction, especially when taxes go this way.
Yeah, and it's protection too. It's protection too. So once again, what you haven't seen me explain ever is this other branch here. And what I put on here, this example is like GLP. Greg and Lisa once again are out here, and Lisa's going to give me shit. I know for sure for putting them at 40% and us at 60%. Huh? She's going to give me a hard time for that. But Lisa, I had to. Okay, I didn't want to do it just plain vanilla 50-50. And I ain't going to take less on an example. No way. Okay? So on this example, the managing members here are MF Capital Partners and GLP Investments. Okay. This is where all the voting rights voting is done. This is where all the management decisions are made. This is where the asset management fees are paid. And then you have our Class B members here, which once again are still MFCP and GLP. But MFCP and GLP, those essentially branding companies, don't really own these shares here. What it is, it's our holding company. Our holding company, so for an example, MFCP Holdings, GLP Holdings, this is where your cash flow, equity returns, those kind of things are paid there, right? Returns from the actual property, not just management, based returns. This is, and then your Class A members is an example as well. 70%, the example that I put here is that each investor invests $1 million, and they would own 33.3% of the 70%, right? This is a basic breakdown with this LLC structure, like we talked about, which is our preferred structure, with a holding company there as well.
So I think it's important, hang on before we go there, is, this is an example here. So when you guys look at 33%, it's important to know this, is when you bring someone in and you're going through the lending side, right, that no one can own over 25%. It's not that they can't own it, but if they do own over 25%, you're going to have them underwritten. So there's a lot of times, Brett, you just asked a question at the beginning of structuring. Is it important to know at PSA or at underwriting? On that part, it would be important to know at underwriting how much an investor can put into the deal. Right? If you know your investor and they're okay with being underwritten, that's okay. That process can take longer and can prolong your loan process. So it's important to know that as you go through Class A members, what percent do they own?
Defining it, right? And Lisa said sometimes it's 20%. It is. It depends on the lender. It depends on what the loan is, and they'll let you know what that is, right?
Question. Hello?
Yes.
Yeah. So for the Class A members, how is it 33.33%? Is 70 divided by 3, right? It's 23.33, I think. No?
No, so that's of the 70%. So that's 100%. They own 100% of the 70%, right?
Right.
But only 70% of the deal.
Right. So they are 1/3 owner.
But you're exactly right, though. Of the overall deal, that percentage is going to be less.
Right.
Because it would be 20% times the 70%, which would give you a different amount.
Right. Okay. That's what.
You must be an accountant.
No, I'm not.
All right, this gives you an idea, though, of at least the LLC entity structure, okay? I don't know what just happened there, just cut off, but okay, now we have our waterfall. Now, a waterfall, there's 5 basic components. It's okay, right? No stress, but I think it's the core. Yeah, we're good. Okay. There's 5 basic components of the waterfall, okay? The 5 basic ones, we'll go through all these. We have the return hurdle, we have the preferred return, we have look-back provisions, catch-up provisions, and then we have a true split. There's different ways and different things that we can include. I'll show you which ones we typically do, which ones we typically don't. Okay, but it's also important. I have 2 keyboards up here. It's driving me nuts. I can't remember which one controls what. Let's talk about what a waterfall is, though, okay? A waterfall is, a real estate waterfall is used to describe how different investors are repaid their investment through a share of the cash flow distribution, right? So I want you to think of a waterfall in where a water, just like a typical waterfall out here in Maui, right?
That was pretty good, man. In Hawaii, waterfalls. That's wow.
It flows from the top down before reaching this other level, then it pools up, and once it overflows, it funnels down to the other level, right? A real estate waterfall is very similar to that. There we go. A real estate waterfall is very similar, where, as a basic idea, the preferred return would be paid first, then it would filter down to, where the other investors are paid as well.
Thank you. I appreciate it. It's just I've been made too much of it. Yeah, I've been sharing.
Is there a sample limited partnership agreement with these stipulations within it we can use it for review? So, is there a sample limited partnership agreement? So all these terms and these hurdles and these things that we're going through are going to be outlined within the PPM, which stands for the Private Placement Memorandum. That's what your SEC attorney puts together for you. And so who decides these? Well, we decide these, right? We decide which of these clauses are in there, how it's structured, how the waterfall works. All you need to understand is that you have options with how it's structured, and you need to know some pros and cons of what those structures are. And we need to make sure that we're, explaining it to investors properly, right? So, and listen, there's a ton of different ways that these things can be structured. It's complex as can be, but there's usually these different benchmarks that need to be met before us as sponsors or general sponsors get, to participate in any cash flow, right? And the whole reason that we have these kind of things, it's designed to keep us as sponsors or general partners, right? It's designed to keep us motivated throughout the deal and ensures that some, our interests are aligned, and it just keeps us motivated. But there's pros and cons to each of these, man. There's some that we include, some that we don't. So let's go through the capital stack for an example. Okay, the capital stack is essentially where the money is coming from. Okay, where the money to purchase the property is coming from, and it's usually within these three different areas. And we'll explain these. Okay, you have senior debt. Who's senior debt?
It's gonna be Fannie Freddie.
Fannie Freddie loan, right? That is think of it this way, within this waterfall, okay? Whoever gets paid first, whoever's the highest priority, is the lowest risk. They have the lowest risk, which also means that the returns are low. Like a Fannie Freddie loan, right now, maybe you get a Fannie Freddie loan for 3.5%, 3%, whatever it is. That's a pretty small return. But Fannie and Freddie is looking more at protecting their downside. They limit their upside, but they also protect their downside, right? They're first in line. Now that could be, senior debt could be, your Fannie Freddie loan. It could be a bridge loan. It could be a private debt investor that comes in, private investor that covers the debt side. A bunch of investors that could come in and handle senior debt. Most of our deals, though, are your Fannie Freddie. That's one portion of your capital stack. And here's your pop quiz trivia question. Typically, how we structure within that capital stack, how much of the entire money that we need to put together for the deal, how much does the senior debt typically cover? What percent do they typically cover? There we go. Yeah, it's anywhere from 70 to 80%. It could be less than that too, man. Okay, but then you have preferred equity as well. Now, you have your debt side. Now you have these equity classes here, okay? Your preferred equity is not always used, but it is an option. And what preferred equity would be is they would be first dibs in line, so first position in line after the debt service, but it's usually structured different than common equity. Common equity is what most of y'all are more familiar with, but I'll give you some more variations here. But preferred equity is maybe they come in, they put a big amount in, they don't want any equity upside, they just want higher cash flow, right? So give an example of how preferred equity would be structured.
How would it be structured or given back, or the 10%?
Yeah, like how would it be paid with no equity, but like a higher return?
Yeah, so it's kind of like the group out of Canada a little bit, right? They want 10% on it. So, it is. I think one of the reasons we haven't done pref equity is this: you have to make sure that your deal is performing cash flow wise right out of the gates, right? I mean, you're having to pay them 10%. It can vary, but you're paying 10% of the cash on cash, to your investor. They don't want any of the equity. I think I've talked to actually a few of the students about this. They go out and they start looking at LinkedIn or wherever, and they start trying to find all these different groups. In fact, there's a group out of Charlotte. I think it's New York Pref Equity or something like that. And they're a great company, man. They give just a ton of money.
Did you about to say shitload?
I said shitload, man. It's Mother's Day weekend. Sorry, ladies. I try to clean my mouth out. The Hardys, Cindy, Bishop Hardy. I apologize. So anyway, but. That's kind of funny.
Hey, I'm a bastard. I just married somebody. I'm considered a father time.
We're in a lot of trouble when Tyler starts marrying people. Oh boy, this is bad. Anyway, so they'll go out and they want, anywhere from 10 to 12%. It's interesting. I can kind of ramble off. Is I see a lot of people underwrite deals, and they underwrite them and they show them to these different, institutions, family office, pref equity groups, and they say, hey, listen, this deal's doing 25, 30%. They want the deal to work and make the numbers look great. We got to remember when you start showing that to a lender, right, or to an investor. All of a sudden, they're going to start wanting more of the cash on cash, right? They're going to want more of the, 10% pref return back to them, 12%, 14%. That's probably one of our mistakes with the Canadians.
Yeah, totally.
Where they wanted 8, 10, and 12. That was a waterfall that I'm sure you'll have an example you'll go over. But that's kind of how a pref equity group works. Now they're great to work with, but you've got to make sure your underwriting is just solid.
There's pros and cons to all this. The pro is yes, they get more of the cash flow, but they get none of the equity side, right? So that's a beautiful thing.
Round two.
Oh, jeez. And it could be right where they don't cover the entirety of the equity, so that would be paid first, though, remember, and then you would have your other, more common equity that gets paid in the waterfall. So you'd have your debt waterfall number one, preferred equity, and you'd have your common equity. Now, most of us, though, use common equity, but how most of y'all have been taught is that, and this is once again the most common LP limited partner position, right? Now, how most of us have been taught though is just one. This is one idea. We have a 30, a 70-30 split, right? So a 30% carve out, and those investors get a preferred return, and that preferred return is let's say 8%, right? And it's just cut and dry. This is what it is. But there's different ways to handle this side too, right? Even on common equity classes, there's some investors that maybe all they want is just cash flow as well. So this preferred equity, I want to make sure I clarify this. This could be there, or maybe it's not there. Most of our deals, we always have senior debt, and then we have common equity. Preferred equity is an option, but it doesn't always need to be there, okay? Now, common equity though. So Class A, let's say that we have some investors, a good chunk of investors, maybe like a fund of funds, that all they want is just a basic cash flow return. They don't necessarily care about the equity. They just want higher cash flows, okay? So maybe this common equity Class A, they get paid, once again, next in the waterfall, but maybe it's just a cash flow return of, let's say, 10%. It's a flat 10% there. Okay, then you have common equity Class B and Class B1. So Class B, maybe that is, so for example, let's give this example. On our deal right now with Summit Landry Way is a 224 unit deal we're about to close in Fort Worth. And we've offered investors, we don't have this tier where somebody's just getting cash flow. We have two common equity class types. We actually call it Class A and Class A1. In this example, that Class B, and Class B1. So Class B would give, for an example, they've invested a minimum of $250,000. So they've invested a higher amount, right? But because of that, they get a little bit higher preferred return. And on this deal, it's 8%. So it's an 8% preferred return, plus they get equity. Now, Class B1, these guys have invested a little bit smaller. Our minimum return, our minimum investment on that is $100,000. So these investors have invested $100,000, which is lower than $250. So they still get a preferred return and still get to participate in equity, but their preferred return is 7% instead of 8%. So this is what Ryan's talking about that we started doing about a year ago, where we can give investors the opportunity to invest more, motivate them, incentivize them to invest more money into the deal. And if we do that, we give them an 8% pref. And what we used to do is just offer an 8% preferred return to everyone. Yeah. But what we realized is if we split that out, it motivated people, incentivized people to invest the higher amount, right? Because they wanted that higher return. So once again, it makes your raise easier, in my opinion, because it motivates these people to make that stretch to that next tier so they get the better return, right?
It's interesting. You guys think that, maybe some of the investors, it's easier to get $100,000 out of people than maybe 250, 300,000. And the last two times that we've done this, it is crazy. So we set a certain amount, right? And it's important to know that. You don't want to just give everyone. You want to limit the number. Now, that doesn't mean that we can't give more. As a management, we can decide to give more. But typically, we'll allow 50% of the raise. So in this case, in some is 8.8 million. So we take 4.4 million. And we say, okay, out of that 4.4 million, 8% is going to be paid out, or 7%. And I kid you not, man, it goes so fast, man. It is, those ones are taking up the first, right? And it's crazy. The last one we did, Tropical, we actually went a little over the 50%. But that, I kid you not, that was done in less than 24 hours. It was crazy.
It is actually a bummer because we wanted to participate in the higher tier, invest more and get the higher tier with some of our money as well. But those Class A shares, those Class, B in this example, those topper, the higher investment shares were taken so fast that, we had to give them into, to our investors instead of taking, instead of us, which is kind of a bummer. Because remember, you have to calculate your returns, right? So this amount of money is making this percent, this amount of money is making this percent. So you have to make sure that those all filter down to the bottom line, right? Zach, as you're going through this kind of stuff and learning underwriting, you have questions on how those tiers are, we can show you, give you some examples of how to do that, right? But Chris said it's a scarcity mindset. It's so easy. Chris, I never called you back yesterday.
Shoot.
Oh, my word.
You're turning into Ryan.
Gosh, I apologize, my man. I just realized that as you freaking,
Chris,
apologize.
No, it was my fault, Chris.
It is Ryan's fault.
I didn't get the pudding with the sandwiches yesterday. That's my fault, Chris. He'll call you back today.
I swear. Okay, but it is a scarcity mindset. And it's so much easier to have that scarcity mindset in the beginning because, well, at least for me, it was like, man, who has that much money to invest? But the more money you have, the easier it is to raise money because you realize there's a lot of people who have big chunks of money to invest, and it's easier for them to make, instead of make 3 different decisions for $100,000 each, they can make one decision for $300,000 and get a higher return, right? It's incentivizing them to put that money into one space. Okay, so that's your capital stack. Okay, that gives you an example of your capital stack.
You started to say really quick though, Zach, if you guys ever do split, which you probably won't do on your first deal, you'll probably do make it simple, 7% preferred returns. But if you do choose to split it, make sure you reach out to Zach. We have a template that MF Capital Partners uses. It's the same template you use. It's just manipulated a little bit. So he can give that to you. We can manipulate everything. No, but
No, I'm laughing at Cindy's comment.
oh, Cindy's comment.
I know you're on my list for this quarter. Don't even think about it, Cindy. I'm making it happen for sure.
I like the
You
quarter
too,
though.
man.
That's the quarter.
Yeah.
Yeah. No, so you can reach out to Zach and he can give you those splits of 7 and 8% or capital stack. So he can make those changes pretty quick.
Yeah, show you how to do it. And there's no reason you shouldn't do that on your first one, man. I honestly like it. What's interesting, the reason I think it's so important to have this conversation is just to know that there's options. Because I didn't even know that there were different options for a long time into this. And then you realize, man, there's so many different ways that you could have got creative there. Okay, so let's talk about these waterfall components, okay? One of those waterfall components is what we call a return hurdle. And your return hurdle is, well, used to define the rate of return that must be achieved before cash flow can flow to the next waterfall. So let's say that return hurdle, we had an investor group that you mentioned out of Canada where
A bunch of assholes. They were just assholes.
easy. Hey, do me a favor though on the chat, okay? Because some people are just making some comments and then some people actually have questions. But remember, it's so much easier for us to filter through and answer questions if we capital letters the word question and then ask it. It'll help a ton. But I'm not clear about the percentage about the returns. During the seminar, you talked about 16 to 23% of returns. I already started to motivate some of my investors with this percentage. Those are the returns. Those are almost all of our return projections, Beatrice, are in that window. But remember, you can structure this a million different ways. Okay, if you're only going to incentivize your investors off of cash flow, once again, you can just offer them a cash flow return. If you're going to offer them with cash flow and equity, which most of us do, then they would get their whatever cash flow return, the preferred return of 7%, 8%, plus their equity returns once we sell. The point though, and once again, I'm going to stress this again, there is not just one way to structure. There's a million different ways to structure to filter down to the returns to get to those bottom lines, okay? But the most common, Beatrice, is what you just said. But I need you guys to open up your minds to different opportunities to structure, because that's what I'm trying to teach you here, is that there's a whole bunch of different ways to structure. That's the whole point of this class, is helping you understand this. For example, the return hurdle. Okay, the return hurdle would be, a lot of people structure this way where, let's say they offer a preferred return, which I'll talk about in more detail in just a second, but we do a true split, which is bullet point number 5 I'll cover. But a return hurdle would be like this. Let's say that the return, the hurdle that we need to hit before we participate in any cash flow, let's say that that's 10%. Well, that means 10% would go to the investors, and then the remaining portion, right? The remaining portion would then be split 70, 30, 50, 50, 60, 40, however you determine. So instead of having a true split, you only split the amount that's left after this return hurdle. I don't think we've ever structured a deal this way, correct?
No, yeah, I don't.
We've never structured a deal this way. And it's typically, the return hurdles are typically based off of, an IRR, internal rate of return, or an equity multiple, or your preferred return, okay? And once again, the purpose of a return hurdle is it's really structured to incentivize the sponsors to, manage the project efficiently and as profitably as possible, so that they actually get to participate in the cash flow returns. But listen, and some investors will look at that as, hey, this is a great thing. I want to make sure that there's a return hurdle. I'll be honest with you, I disagree, because if there is a problem on the property and there's something that is causing that return hurdle not to be met, which is just reality sometimes, I want to make sure that the investors or the operators are still motivated to continue to put in the work to get there. And if they're never going to see anything from their hard work, they're not going to put the hard work in. Okay. So I honestly, none of our deals are done through a with a return hurdle, and I've never passively invested into a deal with a return hurdle either. I like a true split. Once again, everyone's different. So once again, for example, let's say that the deal is expected to have, an 8% cash on cash return, and that's the return hurdle. Then the first 8% would go to the limited partners, then the waterfall, and then the next tier of the waterfall, those remaining funds there, right, would be split. However you decided to split those. Once again, 80-20, 70-30, 50-50. There's been a whole bunch of ways to do that. Okay, that's your return hurdle side. Your pref return. Explain the pref return, man. That's very common. This is what all of us have most of the time.
Are you talking about a capital transaction or during?
No, just a preferred return. What this return hurdle means, just on all of our deals, it's the same thing.
So yeah, this can be done a couple different ways. Typically, like Tyler just said, 7-8%, we get the rest, right? Typically, there's a lot of different ways to do it. I'm confused the shit out of them right now. Is that all right?
Let's see it.
Let's see it, So a lot of people do it different ways. And this is where it's important with your SEC attorney to make sure that it is put into those documents so that your investors know. So many people, they'll ask you, is it a 70-30 split? Let's say after the investors get their 7% or 8%, you see a lot of people split it after that 70-30, right?
And that would be more your return hurdle, right? So just basic preferred return, real quick before you get into those details, before you confuse them. A basic preferred return, all that means, it's the first claim on the profits It's just the first claim on the profits, right? So it's once again, we typically offer a 7 or 8% preferred return. It's very common. And these passive investors, they need to at least hit this preferred return before splits are made, right? So it's that first claim on profits. Now I can get into it.
Okay. So it is, it's important to know that too, right? Are you going over catch-ups at all?
That's one of the return hurdles.
Okay. So, like Tyler said, they get the first, investors get the first 7%, 8%, whatever, 10%, whatever you guys determine, that the investor gets. Typically, like he said, 7 to 8%. After that, then it's split, right? And this is where it gets really tricky, and this is where it's important to know with your SEC attorney and to explain it correctly. And this is where using Bethany, with you guys is important. She knows how we do it. And then there's ways that other SEC attorneys do it. And if you don't do it correctly, you have to follow after everything's signed what the PPM says, right? What your subscription documents say. And so what we do, or what the common investor does, is they give the first, 7, 8%, and then they do a 70-30 split, let's say, or 80-20 split. Well, that doesn't leave you with a lot of cash flow, right? Afterwards.
Return hurdle.
Yeah, it doesn't leave you with a lot at all. I mean, if you were to break it down and what we can do is have Zach do it on one of our underwriting calls and show you the difference. And I'm sure you can see the visual of that. It doesn't leave you with a lot at all. In fact, I think I see the Hardings up there. That's how they were taught probably how to do it as well. But what you can do is take the first 70% of it, as long as they get the 8% or the 7%, then you get the rest. So it's a true 70-30 split. They're just getting the first 7 or 8%.
Which we will cover.
Which we'll cover, okay. So it's important to make sure that your SEC attorney knows that it's a 70-30 split. They just get the first, whatever the preferred return is, so that you're getting the other 30%.
Okay, and think of this way too. Your preferred return is kind of like interest. It's almost like interest that you would pay to a bank, except there's two major distinctions here. Okay, number one, it can be paid either current or accrued, right? Whereas a bank usually is only current. That's only current. Well, and current means it has to be paid each quarter, each month, whatever y'all determine. Where accrued, it can be earned and then paid later, right? A preferred return can be earned and then paid later. The second distinction is it's not guaranteed. Like a bank is guaranteed money, we have to pay it. A preferred return isn't guaranteed, right? Investors are first to get paid after the banks, but it's in the form of a preferred return, right? So they're going to receive this distribution of profits, provided that there is actual profits to be distributed. And then after, once again, the preferred return hurdle is met, then a lot of the times people will split the excess between LPs and GPs at that point. Once again, we do a true split, which, and so we'll show you, different makeups of the deal. We do a true split, which I'll cover in a second. Now we have the look back clause. Now, once again, we don't use this clause either. Let me explain how this clause works. But I'm going to tell you that this is a common clause if you're using institutional funds or family office funds or something along these lines, which this means that if the investor, if they don't get this, prearranged rate of return, then the look back provision would kick in at this point. So let's say that the sponsor, at that point, meaning, let's say the sponsor has been paid out some returns. You're now ready to exit the deal. They haven't hit their minimums. Okay, well, that means the sponsor would then have to give up a portion of their already distributed profits. So let's say you as the sponsor, us as the GPs, we've already made a percentage of this cash flow, and now we go to exit, and these investors haven't hit this minimum predefined, return that we were projecting to them. What that means is we literally have to write a check to these investors to cover this look back provision, to cover the difference there, to make sure that we get there. And most of the time that would be done from the sale of an asset, right? Once you go sell, some of those returns would be taken from there. But this is another provision that's designed to motivate the sponsor. But we do not include this in our deals. We do not include this in our deals. And once again, you just have to be clear with your SEC attorney that you don't put that in there. There's no way that I'm going to get to the end of a deal and then need to cut a check back, right?
Could you imagine our deals right now, the one we're working on is what, 1.4 million acquisition fee, having to give that back at the end? That would be awful.
Yeah, portions back for sure. We don't include this, but it is, you'll see it. I'm telling you, you'll see it out there. We don't, put that into our deals. A catch up, requires, so here's your catch up. Investors get 100% of the profits until the agreed upon return has been met. Then the sponsors are caught up. So instead of this split, a catch up provision typically works like this. 100% of the profits would go back to the investors until the investors receive either a return or sometimes even their initial investment back plus their return, which means if you've ever heard me talk about our Signal Hill deal, the Signal Hill deal they tried to structure this, sneak in a catch-up provision into the clause or into the operating agreement, meaning that they would get 100% of the profits until they got their initial investment back and this, predefined return that they put in. That's why if you've ever heard me, this video that I talk about Signal Hill and losing $3 million in overnight, kicking those investors out. The reason we did that is because they tried to sneak a catch-up clause in, which once again, that means we wouldn't have made money on that deal until past the acquisition
5
fee,
years,
yeah, we wouldn't have made money until like year 5, right? So once again, if you have somebody who's bringing in the entirety of the raise, they're going to have some more say on an operating agreement like this. And so it's you need to be very aware of things that they may try to sneak in there or put in there without you even understanding. If you have the dialogue, that's one thing. We didn't have the dialogue with them. They just tried to sneak it in.
Well, and I think it's important to, and I know we touch base on this a little bit later, but family office or bigger investors, they seem attractive at first. When you're first doing deals, I've talked to quite a few students so far who will be like, I've got an investor that has 2 million, 3 million, 4 million, 5 million. Guess what? They all have a lot of say, right? And they have more control, and so control, sometimes you'll hear Lisa talk about this. Maybe we should have her on another show. I'm sure you guys would love it. Is talk about control, right? Control seems, 3-4 million seems awesome. Like this group, $3 million. But think about it. We got $222,000 in acquisition fees on this. And we would never have seen any cash flow, period. Past that. And so the thing is this deal, Signal Hill, we were killing it on it. And we're actually, as a GP team, taking cash flow, right? And we started, two quarters into it or something like that? I think the second quarter we took cash flow already.
Yeah, and we would have never seen that had this been in. And so breaking this down a little bit farther, it takes the first tier in the waterfall. Your investors would take 100% of the profits until they hit this predefined return. Then sponsors would be caught up with, they would take 100% of the profits to then catch up at that point. And then, to get typically the same return as investors. And then any excess after that would then be split, between the parties, depending on how you determine to split it, 70-30, 50-50, 80-20, whatever you determine. And what's crazy is this catch-up provision here. It's a variation. It's a variation of the look-back provision, and it's used for the same purpose, right? The major difference though is with the look-back provision. Once again, the sponsor could end up writing a check at the end, whereas this catch-up provision, the sponsor, provides investors with 100% of the profits, to make sure that the return's met before they take anything. But once again, that means that those sponsors may not make money for a long time on that deal. So anyway, hold on, one question here. So yeah, you need to make sure to answer this question. So make sure we don't have the provision, the look back provision or the catch up. So we actually do sometimes have a catch up provision in the deal, but we structure it differently. We do not do a look back provision. We never have, and I would suggest that you never do that either. But sometimes we have a catch up, but we structure that catch up differently, where investors would make their money, but it's not that they're getting 100% of those profits. What that means is that if we have lacked in cash flow, then once they get to that, then we would take our portion. But it's never that we never structure it where they get 100% of the profits until they hit this minimum. How we structure it is if we've lacked in our cash flow returns, then once they do hit something, like say upon exit, then we would be caught up and then we would split. But we never do it where they just get 100% right out the gates. We never structure that way.
I think it's important to know, are we going to go over catch up more? Or?
No,
okay. So I think it's important to know this too. There's a couple different ways on catch ups that work. You can catch up quarterly on the next quarter or the quarter after, or like what Tyler just said, at the very end. And so it's important to know that is included in your documents as well with your SEC attorney. Because here's the thing, if you catch up, right, on the next quarter or the quarter after, there's a chance that, as a sponsor, you don't see any money. To where as long as and it all comes down to transparency. Tyler talks a lot about transparency. If you just tell your investors, hey, no, you didn't get a preferred return this quarter, or like it's very typical, the first 2 or 3 quarters that you have a property, the investors don't see any, distribution on those quarters. But that doesn't mean they're not accruing that at the time. That just gets paid out at the end. And so if you try to catch up throughout the process, you may not see any money for, a year, 2 years. Yeah. If you paid out at the end, then you start seeing money as a sponsor. So
yeah, or you can start, catching it up slowly as you go, or something like that.
Which we did out in Signal Hill.
Which is actually that's what Lisa just said, is to tell them how we did. Tell them how we did the catch up on Signal Hill after COVID. So I'll explain it real quick. Yeah. With COVID, even though Signal Hill was still profitable, we paused returns. We paused returns because there was uncertainty. We wanted to make sure that everyone was safe and that we knew what was going on, and so we paused returns, even though the property was still profitable, which is never an easy decision to make, but it's the best for the deal. But then we continue to stack this money because the properties continue to be profitable. Then we can start catching up.
Yeah. So what we did, like what Tyler said, we decided not to pay out distributions. We had plenty of money in our account, and we could have done it. And we wanted to make sure that money, stayed there and that the property was, was healthy. So what we did is we just paid out 0.5%. So on this one, it's an 8% preferred return. So each quarter it would be 2%. And so what we did is so that we didn't pay out the whole 2% again, we paid out 0.5% each quarter to catch them up. Why did we do that? So that we could make a distribution as well, right, on the GP side, and then our investors could be caught up also. So we did it over 4 quarters. We just paid out our last 0.5% to them quarter 1 of 2021, and guess what? They're stoked.
Yep. Okay, now I see a couple questions. One is with the preferred return, the 7 to 8% comes out of the 30% carve out profit. No, the 7-8% is that preferred return is structured two different ways. It can either be a return hurdle, like we talked about bullet point number 1, and then the split's taken out after, or it can be used as this benchmark, which I'm actually just about to cover how we typically structure the preferred return and how that is. So give me 1 second on that, Chris. And the other one, in case of emergency, have you used hard money lenders? What's your thing about them? We've never used hard money lenders, or we don't suggest using hard money lenders. I did on my very first deal, but I've never used it after.
I think it's important on this, though, supplemental loans and stuff like that. This depends on what kind of loan you get also, right? You have to know, like typically on a Freddie loan, you can't get a loan on the back end. So you need to ask your lender, or sometimes you can't get it after, you have to have the property for a year. And then there's specific metrics that you need to have in order to get like a supplemental loan.
I think he's more talking about, Jose, correct me if I'm wrong, you're talking about using hard money to raise the actual equity for the deal.
Okay.
But first off, we wouldn't suggest it at all. And we don't, it's very rare that we use hard money on these deals anyway. There's better loan structures, I guess is the best way to put that. But this is how we typically structure, okay? It's a true split, and sometimes that preferred return becomes mooted, meaning, see if you know what the definition of mooted means.
Like a moot point?
Yep, what does that mean?
It's not relevant?
Hey!
Yeah! Hey, listen, if the monster's waking up at 3 a.m, I'm still good.
Here's how it works. So first off, the definitions. This means profits are split equally as long as the investors receive a minimum of the allotted preferred return. For example, okay. So, and this is how our deals are structured. You know, it keeps us safe. It keeps investors happy. It lets everyone participate. Actually, 2 things that I want you to note, though, and I want you to write down before I forget to say this. 2 things that are very important with your preferred return. Number 1, it's non-compounding. It's not compounding, meaning it doesn't compound year to year. So number 1, you want to make sure that it's not compounding. And number 2, it's not guaranteed. It's not a guaranteed return, meaning we want to, we just talked about catching that up, and we always want to make sure we catch it up, but it's not a guaranteed return. If it was a guaranteed return, that's essentially your look-back provision. That's your look-back provision at that point where you may have to stroke a check. So 2 points here. Number 1, it's not compounding. Number 2, it's not guaranteed. And you need to make sure that you're talking to your SEC attorney about those things, because once again, they're gonna structure things with whatever they feel is normal for them. And every SEC attorney deals with a whole bunch of different investors who have different norms. So just remember to just have this conversation and make sure that you're getting very clear with it. So number 1, not compounding. Number 2, not guaranteed. So, for example, let's say we have a 30% carve out. It would be, initial cash flow is going to be split 70-30. So instead of this return hurdle, and then we take our split, it's a true split of, let's say we have 100,000 of cash flow. Okay. As an example, 100,000 of cash flow. And if it's profits that are ready to be split, well, if it's a 70-30 split, that means investors would get $70,000 split amongst them and their shares. We would get the additional 30,000. As long as that 70% equates to at least the predefined preferred return. So let's say 70,000. Let's say it's a 7% preferred return as an example, and let's say that 70,000 does not get them to a 7% preferred return. Well, then what would happen is the limited partners would continue to carve out more of the profits until they at least hit that preferred return. So let's say that it has to take them to 80,000. 80,000 then gets them to their preferred return of 7%, which means they would get 80,000 split amongst them. We would get the additional 20,000 at that point. Right? So the reason we call it, a true split with a mooted preferred return is because as long as the cash flow proceeds at least hit their preferred return, then the preferred return is moot. It's a moot point. It doesn't matter anymore. It's just a true split. Okay. So let's say that, for that same example, let's say that it's 100,000 in cash flow. It's a 70-30 split. Let's say that the investors get 70,000, and let's say 70,000 equates to a 12% return to those investors. Awesome. Investors would make 12%. We would still get our 30,000 over here. We want them to make as much as possible, but we want them to make at least this minimum portion here, right? But we want our carve out, our split to be a true split. We never structure with that split after the preferred return, after that return hurdle there at that point.
Because then explain. Because they get the 70,000. If we had to split 30,000, that's 70%. That's not a lot of money at all.
That's a great point. So let's say we in this example, okay, this 100,000 of profit with a true split of 70-30. Okay, but let's say instead we did a return hurdle of the preferred return and then split the remaining profits. Okay, let's say that to get them to that preferred return, let's say that would be $70,000 as an example, and there's $30,000 left over. Well, now what would happen is that $30,000, instead of going to the GPs like it is through a true split, if you had a return hurdle, it would be that $30,000 that's left over. That would then be split 50-50, 70-30, 80-20, however you defined, if you used a return hurdle, which once again, doesn't leave a lot of meat on the bone there for us to participate in cash
That's
flow.
what the Canadians wanted to do to us, right? They were getting 10%,
Oh, yeah.
12%. Then they wanted to take what was left over.
Yep.
And this deal, after 3 years, at least I could say, I think after 3 years, this thing was up at like 18% cash on cash. And they wanted to do a 70-30. I remember we negotiated several different times on it.
Oh, yeah.
But think about the $30,000 though, right? Of that, 30% of that would be only $9,000. So now you're not getting 30,000, you're only getting 9,000. And this is where it's important. Aisha said, I don't want to get a headache. I want to just use Bethany, right?
Oh, yeah.
We're not saying use Bethany, man. That's just who we use. But it's important to know that that's in there because a typical SEC attorney will split at 70-30 after the 8% or 7%.
Yeah, because it's common.
That's common.
And what's interesting is some investors offer or do a true split without a preferred return. They just do a true split of proceeds. And I'll be honest, we could structure that way too. It just depends on, what stage of the market cycle we're in, what's happening on the deal. It's not a bad idea either. It's how much, it's just what's the business plan on that deal. But there's some people who don't offer a preferred return. Remember, however you're structuring, you want to make sure that that both parties are being taken care of. Yes, our investors, we need to make sure that they are getting especially what we're telling them they're getting, and making alignments, interest aligned. But also, you're not trying to do this for free. We're not in this. We're not in this as a nonprofit. This is a for-profit business, not a question. So we need to make sure that there's motivation on both ends. To make sure that, once again, I look at it, it's scarcity mentality versus an abundant mentality. I want, as I'm passively investing, I want my, managing partners, my sponsors, whoever those people are, that when I'm passively investing, I want them to make money, because if they're making money, they're going to continue to be motivated to put the time and effort into the deal, which means I'm still going to make money over here, right? I look at it a different way. It's kind of like with, pet fees and a pet deposit. Some people do a non-refundable pet deposit. Some people do a refundable pet deposit. Honestly, I prefer a refundable pet deposit. Why? Because it motivates your tenants to keep the place clean and take care of the unit, because they know that there is a chance that they get that pet deposit back, right? Same type of principle there. Okay, so if you're using a fund to fund on a deal, would you do a true split if that's what they wanted? And to clarify, are you saying if we're bringing a fund to fund in to invest in, an LP position on our deal? So let's say we have a fund to funds. A fund is really all we look at it from our perspective, and they want to invest in our deal. Is that what you're asking? Correct? Okay. Yep. LP, they don't want GP. Would you, if you're using a fund to fund on a deal, would you do a true split if that's what they want?
Answer that?
Yes.
Oh, okay. So if you're doing a fund of a fund, the question would be, there's a couple ways, right? Are they bringing in a full equity piece? If they're bringing in a full equity piece, now it's not a syndication, right? It's a joint partnership on that one. So it's going to be structured differently, and that would be a true split at that point, right? You're going to be 30%, 70%, 80, 20, whatever you decide to do.
Same with voting and stuff.
Yeah, same with voting. So,
but if they're but a more vague answer to that question, would I be willing to do that? It all depends. It does. It totally depends. If they're bringing a big chunk and it makes sense to get them to where, what they're looking for, and it also still makes sense on the deal, sure, man. We're always open to those kind of things. We just need to make sure we have an idea of what that is and run the numbers and make sure that the returns all make sense there. We're always open to getting creative. Are we taking a potty break soon? Do you guys want to take a quick break before we finish it up? Give me a thumbs up or a thumbs down. Do it in the chat, because some of you guys have.
Two monsters.
Okay, let's take a quick break.
Two monsters deserves a break.
Okay, it's 10 minutes after the hour, and actually we should be able to still be pretty close to on time. 10 minutes after the hour, let's come back in 10 minutes, and then we'll come back and answer some questions. So 20 minutes after the hour, I don't know, what time it is wherever you're at. 20 minutes after the hour, we'll start back up, okay? All right, we're good to go. I'm just gonna fill up my water. I think there we go. We just fill up my water, we'll dive back in.
Am I allowed to eat some banana nut bread as I answer questions? Oh, what's that? Hey, Jackson. We just got to get you a Hawaiian shirt, bud.
Talk to me, brother. I know you're supposed to bring one back for me.
This is not Tyler's. The other one's pretty sweet, though. So
Bring one back for me, man. I'd love one.
We should probably put these shirts on our website, man. I know you guys will want some of the Sunday swag.
Yeah, we should.
Stacy Johnson, as long as you don't smack. Come on, Stacy.
Stacy. That's so funny. Before we started, Ryan was like, "Can I eat my banana bread during Jackson?" And I said, "As long as you're not smacking your lips."
Listen, that's why I had to kick my mom out of my house, man. She smacked her food
on Mother's Day.
On Mother's Day, bro. Mother's Day weekend. Stacy, I forgot where are you out of?
I'm in Houston.
Yeah, I remember, Stacy. I don't forget.
Man, did I forget?
All right, hey, we got a couple questions. Okay, I'm gonna answer a couple of these questions and we'll dive back in here. On cash flow, no equity return deals, if this is a syndicated deal, how is the ownership on the deed? It does not change. That doesn't affect any of that. It's all ownership on the deed. I'm gonna cover that. It's a long question, but but that side, that doesn't change. That doesn't change at all. It's just how profits are distributed. So that's all the same. And bank loan made to one entity. The deal split is covered by partnership agreement. Yes, the deal split is covered by the partnership agreement. That's in your PPM, usually outlined in the PPM, the operating agreement as well. How long you'd agree to hold, sell the property. None of that changes. Those business plans and decisions and, voting rights, which we're about to go through here in a second as well, that stuff doesn't change. It's just how profits are distributed with that question, Roberto. I hope that helps.
Aisha, are you on Aisha's question?
Aisha,
You're talking to billionaires. Do they all want look backs? I think that varies, right? I mean, I think that a lot of them want more catch ups. I tell you this, billionaires don't want you to make a dime outside of asset management.
But hold on, let's not group in billionaires. Okay, let's not. What she means by that is that group out of Canada, we refer to them as the billionaires, the billionaire group, because they were billionaires. So everyone has different, preferences and what they want. Just because that is an inside joke between us, because we call them the billionaires and how they wanted the deal structure. So Aisha, don't stress about that at all. We just need to figure out. There we go. I love the nonverbal. I love that. Even the devil. We just need to figure out what they are looking for, and we can let them know, is it a fit for our structure or not.
Got to put the banana nut. I realized why there was a bug in your office today. It's because I've been here all week and I'm messy.
I know you're leaving.
That's why you have bugs in here now. I have crumbs everywhere. I mean,
well, now everyone knows that I have bugs in my office. Jeez, now they're gonna think I'm
gross.
gross.
It's because you're gross.
Okay. All right, let's dive back in. Return of capital. I don't think we covered this yet, right? Okay, so let's go through return of capital. Okay, so we have the other deal components, the waterfall, the entity structure. Right now, it's once we sell the deal, how is that return of capital, that equity, right? The equity portion of those profits. How are those now paid out, right? This is the net capital proceeds split. So once things are paid out, and any profits that result in from a capital transaction, whether it be a refinance or a resale, how are those proceeds split? Okay. Start with number one here. Okay. If there is, once again, all this is also, is this a standard thing, or is there different ways to structure? Type it in the chat for me. Let me know. Is it all just cut and dry, or is there different ways? Make sure everybody's back in different ways. There we go. Aisha, thank you for, there we go. Stacy's in too. Okay. Different ways. So I'm going to show you the most common ways. But once again, there's they say that a bunch of ways to.
Plethora. Can we use plethora?
Plethora works, yes.
All right, it's a big word for me. It's a big word for me.
Sounds like Ewok, man.
It's an Ewok.
Plethora of Ewoks.
Yep, there we go. You got to love the Ewoks.
Typically how this works, right? You have your unpaid preferred return. If there is, something that hasn't been met there, then they're going to get that preferred return, that unpaid pref paid. Then you have the initial capital that they put in, right? So the 100% typically of the investment that they put in is now, reimbursed them. Sometimes, we can reimburse them, different bits of their initial investment throughout the deal. But let's say we go to sell and none of that's been paid off yet. Then the next tier is then we have the initial capital repayment, then the GP deficit. Okay. The GP deficit is the best way I can explain this. Okay. If the LPs haven't received their preferred return in a given year, okay, and then what happens is those deficiencies are rolled over. Now, not compounding. Remember, they're not on a compounding basis, but they're rolled over. And now the GPs. So once again, also with the GP deficit, this doesn't mean that we need to write a check out of our profits to give them. It just means that these profits at the end of sell, once we go to sell, if we haven't hit the preferred return, we can make up that deficit through some of those capital proceeds before we get into our splits, right? To make sure that once again they get at least their initial investment back plus their preferred return, and then we can split the profits down here. So then the next tier of that, but once again, it's not a look back provision. It's not where we don't have to write a check there. It's a very different thing there. Then it filters down into our 70-30 split. Once again, the split of the equity can be handled a bunch of different ways too. How we typically do it is if it's a 70-30 split, a true split, then once again, we would get 30% of the cash flow. We would also get 30% of the equity once we sell. But can those splits be different?
Yeah, for sure they can be different. Can we go back to number 3 really quick?
Yeah.
This maybe not apply to it, right? But Tyler will tell you I have a beautiful mind. It's like Russell Crowe. It's all over the place, right? But he gets it now. It's taken him a few years, but he gets it. So, this is important to know too, though. A lot of you, when you're in your underwriting, you'll notice that the measure cash flow is a negative number. It's a red number, right? So a lot of people will go to Zach and say, hey, well, why is that a red number? How do I get that? But you'll notice on the side, you'll see that the total number that you're behind. It's important to know the GP deficit in this area as well. That's an area where you get to catch up that your cash flow that you've never been paid out. So for example, most properties in the first 12 months we're going to stabilize the properties. So for those of you who have been on the underwriting, the Tuesday underwriting calls, You'll notice that we talk a lot about phases. Lisa is one of the best and has taught me phases, right? So you have typically 3 phases in stabilizing a property. You're going to typically see that in a 12 to 18 month period. So in the first 12 months, as a GP, you may not see any cash flow whatsoever. It doesn't mean that, that just because it's not going into your bank account, you're not seeing it. You catch up at the very end, and that's where this happens. On one of our deals, yes, on Cedars, we could have taken cash flow and we just didn't because we used some of the operations to fix up some things that weren't necessarily in our business plan at first, and we used operation money. But when we sold the property, we caught up. I don't know how much it was. It was 100,000. I can't remember, something like that. We'll use 100,000 as an example. Sure. But we got 100,000, and that came at this part right here where we got paid all of that money before the equity is split, which is awesome because it could be a big check to you as well. And you want to remember that you catch that up because listen, you worked hard on that property.
Yeah, and once again, there's 2 sides to this, right? I'm so glad you pointed that out. I can't believe I forgot to talk about that because so many times we talk about that deficit as going to the LPs, but as the GPs, there's the deficit. And the reason that's important, say, your investors, for this example with the Cedars as an example, say your investors are like, well, hold on, why is that, why is this deficit in there? Well, okay, think if it wasn't in there and you have an operator who's short-sighted or even normal, you have this option here. You can either take your portion of the cash flow at this point, which is what's best for you and what's in the operating agreement. So like it's what's best for, you, the operator, but it's not necessarily what's best for the property. What would be best for the property is for that money to go back into the property, make sure that we have, reserves and all these things in place. And then we can be caught that capital or that cash flow back up during this GP deficit phase here, right? That is what is best for the investment because it makes sure that we're making decisions in line with the investment, not just our own needs there. It just gives us that cushion.
So I think it's funny too. Chris said scarcity mindset. You're always talking about scarcity mindset. I've seen different operators, we call them different things, GP operators, sponsors, whatever. I see them get so caught up on their acquisition fee of them getting money, them getting cash flow. It's all about them. You ask a majority, I would say 99% of our investors, I'm sure you can't make all of them happy, right? But you ask, most of our investors reinvest with us because we follow through with what we say we're going to do, right? And it's not that scarcity mindset. We know that money is going to come, whether it's at the sale of a property, acquisition fees, we're always putting the percentage off, for us. But it's not about us, right? Like Tyler just said, making sure that the property is sustainable and the investors will make their returns. We'll get more investors to continue to invest with you. So don't ever get caught up on it, man. I know a lot of people out there in different networks and stuff like that they just start taking, cash flow first and their properties get, into trouble.
Yeah, it's long-term perspective for sure, making those decisions. So, and I'm so glad you brought that up though. That's when that GP deficit comes into play, both sides, LPs and GPs. Okay, then you have the remaining proceeds that would be split. The example that I put in here is 70-30. You would just define how that split is, and once again, your equity split does not have to be the same as your cash flow split or your ownership. It doesn't. Ownership, what's funny is if you really get into it, your ownership percentage on a deal, it really doesn't matter, man. We could own 1% of the deal and give our investors 99% of the deal, as long as in the waterfall, it says that we split this way, right? The profits are actually split this way. The ownership percentage, honestly, doesn't really matter at that point. It's more how everything is broke down in the profit split there. So however you decide to split those profits at this point. Now, how we used to do it and how we used to do it is we would always just have it say a 70-30, and it could be 50-50, whatever, but it was just the remaining proceeds were just split. But then we realized that, man, we've had a number of deals that have performed very, very well. And that means that our investors have been making, a lot, 60% returns, 50% annualized returns. And that's a lot, right? What we realized is, and once again, you learn so much from getting on calls like this. You learn so much from even passively investing in deals and seeing how other operators do it. So funny. I had you'll laugh at this, but we had a call with someone who will go unnamed that they said, oh man, I don't jump on a lot of the calls because some of the people are new on the calls. Well, yes, so are you. You've never done a deal, man. And every single person, so are you, right? But every single person has this different perspective and this different experience and learned something from over here because they went to passively invest or they, learned something on a call or from an equity partner, another operating partner. Man, there's so many ways to learn. And what we realized is that a lot of investors were setting this threshold here, this ARR threshold, accounting rate of return threshold, which means profits would be split 70-30, for an example, until investors got to this return hurdle at the back end. Let's say our deals are typically 20%. So let's say all this stuff is paid out. Then we do our 70-30 split until investors make, let's say 20%. And then at 20%, anything remaining from there, any remaining proceeds from there, then would be split 50-50. So investors are still making a healthy return, but it also allows us to make a healthy return too without having to really overpay.
I think it's important on this, man. And if anything, it's funny because Lisa just said, you can always learn. And listen, if Lisa knows a lot. I mean, I tell you, we learn a lot from her all the time. And so, it's interesting. We were taught 70-30. We were never taught 50-50.
Yeah.
It was us reaching out and one of our good friends and said, hey, look, man, have you guys ever thought about doing this? Your returns are really good. And I think we were complaining about, it's awesome to the investors, but any investor would do 50-50 after 20% annual returns, any of them. But we were taught the 70-30 way. So I think if anything out of this class today too, man, is when you have deals that are performing extremely well, make sure that this is in your PPM, man. It's 50-50 splits.
Yeah, after that threshold. Once again, there's thresholds, there's return hurdles that, are highly weighted to the investor side that limit our return potential. And then there's return hurdles that actually benefit both parties. We put things in that benefit both parties on here, right? This is one of those as an example. Okay, that's the return of capital. That's typically how we handle the return of capital on a deal. Okay, now we have control and voting rights. And this is fairly simple. Okay, limited partners, the nature of being a limited partner in LP is that you're limited, right? You're limited both in liability and in control. So limited liability, right, means that you can, really the only liability that you have is the principal that you've invested in the deal. Your investors, your passive investors, their liability is that capital that they've invested. That's their liability. They're also protected as an LP, a limited partner. They're also protected by the SEC, in case of a lawsuit or a loss of the building or something like that. So day-to-day operations, typically LPs, there's no real involvement there. We never have our limited partners have day-to-day operations. Those are made by us as the GPs or the sponsors, right? That's our job. When I'm investing passively because I trust that group, those individuals to make those management decisions, right? Now, voting rights, LPs should have, we always say that they don't have voting rights, but they do. They should have the ability to vote on really anything that would reduce their, rights in any way, right? So for an example, they should be able to vote on, let's say that we decided on one of our deals, we want to take a loan out. And it's a loan to us as managers. Well, okay, that limits their rights on the deal. That limits some of their returns. That increases their risk. It changes things. They should have the ability to vote on that and say, yes, we're good with giving you a loan, or no. That would be something they'd vote on. Or any change in the operating agreement. Let's say that we wanted to go in and just change the operating agreement after close. Well, okay, limited partners should definitely be able to vote on those kind of things. In every deal that we have, our limited partners have the ability to vote on that. They also have the ability to remove the manager. Now remember this structure that we had up here before. We have the limited partners, their share. We have the Class B shares, the managing partners, but then we have the managing entity. This is what they would be voting on. They'd be voting on the removal of this manager, these individuals who are making decisions. That wouldn't mean that they wouldn't still get their split of profits. They're still an owner on that deal, but they're not making the management decisions. We'd vote them out of that at this point. This is, let's say somebody is not doing a good job as the manager of the property, or they're going through a bankruptcy or something that could affect the property somehow. Then what we would do, or a lawsuit or anything like that, then we could get together if we're all limited partners and other partners on the deal, we could get together and vote that person out, right?
I remember when we first started, I thought that, man, just one LP person, investors could come in and throw a hissy fit and want it back, right? But it's important to remember that 70% typically of all LPs have to vote on that, right? It has to be an actual meeting or in writing to remove someone. So we don't want you to get nervous of like, hey, look at an LP just because they're upset with you or hold a grudge or something like that. No, there has to be at least 70% for the most part to vote on these kind of things.
Yeah, and once again, that can be changed too. You can define what percent have to agree to vote that out. But let's say somebody did vote you out. You still own the property. That doesn't mean you don't own the 30% of the profits. You still are there. You still have that ownership here. You're just not part of this managing entity over here. That's also why we separate out that managing entity, is it keeps us safe and our investors safe on that. Yeah. They can also vote if we decide to refinance or resell sometimes. Not all the times. Like if we're going to sell, most of the time we just sell. We don't necessarily have that. But if you have a big investor that comes in and covers the entirety of the equity raise, or a really big chunk, they might want to be able to vote on if we refinance or if we resell on that. And then once again, the operating agreement breaks all this kind of stuff down. That's deal component number 4, control and voting. Now, your different investing partners, and I don't know how detailed we want to necessarily get into this. We can certainly get into some, but the most common, okay, syndication, obviously the most common. That is our most common structure. Syndication, multiple investors that cover the equity piece. Family office. Well, these are the 3. We'll get into some of these details. Family office, then we have institutional. Let's get into some of this first. Our syndication, okay? Syndication, your typical, deal that we do is a syndicated deal, has multiple partners that cover this 70%, right? Ownership. And then we get our GP carve out 30%. Once again, we've had deals that are 50%. I think our lowest one ever was 22%. All these things are negotiable, but this is a very common split on this deal with syndication. All of you should be pretty familiar with syndication and how it's structured. That's how most of our deals are structured and what we teach. But we also have institutional funds. Right? So institutional funds, these are, so the definition, a large organization such as a bank, a pension fund, labor union, insurance company that comes in and funds the entirety of the deal. And there are pros and cons with that, right? Let's say that you build a relationship with an institutional investors like this. Well, okay, you're getting a smaller carve out. Typically, a carve out is a 90-10 split, and I'll let Ryan get into some more of these details. Family office is very common with that as well. So the downside is your carve out's lower, but the upside is you have a lot of purchasing power. You can come in and do more deals. Because you have big institutional money behind you.
I think it's important to know too, though. I mean, obviously they're going after like 80, 90, $100 million deals and above. It's important to know this too, is that they don't go after C properties. It's typically Class A properties, new builds, stuff like that. So,
anything else you want to cover on the institutional side?
Oh man, I don't know how I'll ever do it.
Yeah, we've never used institutional money, and I'll tell you what we have explored and what we would, and it's very common. It's very common, very a comparable structure with family office. Family office, these are private wealth management advisory firms that serve ultra high net worth investors, not just high net worth, ultra high net worth investors. Once again, billionaires, right? These families that have acquired a whole bunch of wealth, and now we have these family offices that manage that wealth. I'll let you touch on that a little bit because we talked about this.
I was just thinking, man, I make you look really good. My little body, dad bod here. I guess you're a dad, but
I guess you're a dad.
Goodness gracious, I make you look really good right now.
Thank you, Ryan. I appreciate. You know what? That's why you're a good wingman.
That's like a good wingman. Ewoks there, Sorry, hang on. What was the question? No, private our family office.
What's he paying attention to right now during this call?
Listen, guys, I've been out here all week. I haven't been out to the ocean yet. Come on, I'm a single dad. I'm a single dad looking for ladies. I haven't even been to the beach yet.
Looking for ladies.
There's no secret about that. I mean, come on.
You know what? We're going today, right? We're making it happen.
I need a surfer or something. I don't even know if I can get up on a board. I mean, there's a lot of weight here.
Struggle.
Anyway, all right, okay. So family office, man. I tell you this: when we first started, there's a Wilson Family Conference, for example.
Yeah, they call it the Family Office Club now.
Family Office Club. So it is. Remember, we went there and starting out, you sit there and think, Lisa will laugh about this. I know she's going to laugh about this, but it is family office. You always think when you're brand new, man, these guys can stroke a check, right? Now, you don't even have to get a sponsor on family office because they can do debt and equity, right? So the thing is it seems so appealing when you're starting out to go out and get family office. Well, Tyler just talked about control. If you're going to go do that, you got to know right away you're going to give up control, right? Complete control. That's why we got rid of the $3 million. But it's important to know that this is, can they write a full check? Yes, but they're going to require 10%. So I want you to think about this.
10% what?
10% of the equity. Okay.
So real quick, I just want to make sure that I define this split here. We're talking about the split of profits, right? But family office groups, institutional investors also will do this, where they require you to cover a portion of the equity. So let's say that the equity raise is $1 million. I don't know, as an example, it'd be higher than that, but let's say $1 million. Then you would have to come up with 10% of that on your side to invest in the deal, and they would come up with the remaining 90% on their side. Very, very common. And it could be low. It could be 5%. It could be, maybe they waive it, but most of the time it's 10%.
So I want to get into this because Aisha is asked. So it sounds like it makes sense to have any investor have a big piece of the pie. So this is a family office. It's all determined on what's in your operating agreements and how you structure that, right? So it's not that it's bad. It's about how you structure and you come to agreement with them on. But I used to think, hey, listen, like Tyler said, $1 million, you'd have to come up with 100,000. They come up with 900,000. All right, the 100,000. So think about this, right? If we go to syndicate out the 100,000, who gets the cash flow? It's the other investors you bring in. So you would never see any cash flow. Typically, family office is going to make sense if you're okay with just getting asset management fee and acquisition fee. But if you use family office, acquisition fee no longer is like Tyler taught you, 3 to 5%. It now goes to 1 to 2%, right? Institutional money, acquisition fees, just taking a step back, is only 0.5% to 1%. Okay. So a lot of you guys, especially, look at the acquisition fee as helping fund your company, right? Future expenses. Earnest money, there's a lot of things you can use acquisition fees for. So you got to remember that. But family office, it typically works after you've been established for a while and you have equity, right? So like Tyler and I have equity, Lisa and Greg have plenty of equity. So the thing is, if we were to go in together, we could put in, 100,000, or let's say it's 5 million. We put in 500,000. Well, now the splits, it's a true split, right? It's not preferred returns. It's a 90-10 split. So they would get 90% of cash flow, positive cash flow. We'd get 10% positive cash flow. But the kicker is, the nice thing about family office, once you get to that point, is once all capital is paid back, it's an 80-20 split. So you're typically using family office when you're going after bigger deals. But be careful, because I hear a lot of people that reach out to us will say, hey, I went and found family office money, or I found this. If you're starting out as a new student, we thought the same thing at first.
Yep.
And it seemed so appealing. I remember Lisa laughed at us, nope, and we're like, no, it's awesome. It's awesome. And it is, several different ways. You're not going to get as much cash flow, not going to get as much acquisition fee, not going to get as much equity, and you're going to lose a lot of control.
And that is typically, right? So like typically, there are some, you might be able to structure a deal with the family office group and structure it differently to align with your interests as well. What we're saying though is it's very uncommon. They're going to come in with a huge chunk of money and they're going to want a whole bunch of, they're going to, you essentially become, how we look at it, you become an employee at that point. All of us, so most of us are in this to not be an employee. We want to be able to do our own thing and make decisions the way we want to be able to make and scale and grow. And a lot of those rights and that ability is taken off from family office. But listen, some groups love to structure that way. That's where they roll, and they just do a lot more deals. I'm all about quality, not necessarily quantity.
Well, I'll say this. I mean, the pro of it is this, man. If you're having struggles with sponsors or anything like that, I mean, great, man. They'll cover the debt and equity a lot of times, and so that is a pro of it. If you want to explore that option, just know, like Tyler said, it's going to be a lot of more of an employee.
Now, tell me the downside of syndication, though.
The downside of syndication.
Yep.
I don't know, 1.4 million in acquisition fees is pretty good.
But what's the downside? How do we get there?
How do we get to the downside?
No, how do we get to those? Because what's the downside of syndication?
Oh, no, yeah, okay, so I get it. So the downside of syndication is this, right? Is you got private investors or just common folks, right, that are looking to invest, right? You get to a certain point, and I think this is where you're heading, right?
I don't know. I'm going to see if
Let's
you're
see.
answering right. I don't know.
Man,
Everyone pump your brakes.
I might be thrown out of the partnership on this, guys. Oh, no. So, no, but the downside is this, you can only reach so many people sometimes, right? Or let's say that you run out of capital, you run out of private investors, you get to a certain point where you've grown so much, right, that to where now you need to have your money work for you. Okay. So, like us, we have, plenty of money in liquidity. The parishes have plenty of money in liquidity. We may get to a point in 2 or 3 more deals where it doesn't make sense for us, or not that it doesn't make sense. We may reach a cap or threshold on investors that we have. And that's, I think, why you see so many people go out and try to find other capital raisers, because they have different pockets of investors that can come into deals. But what does that mean? You're giving up ownership and percentages that you could have. So it may make sense to go over to family office at some point.
Yeah, it's work. Here's the downside. I mean, that was a very great answer. But
can I say the partnership now?
Yes,
okay.
Yes, you were in.
Oh.
You're still. The most basic, simple answer is it's work. It's work. Listen, there's only one way. I want you to write this down. There's only one way to get returns, and it's through investment. Period. There's one way to get the returns. That's through investment. That is not. I'm not just talking about money investment. I'm talking about anything. If you want an investment, if you want a return on your relationship with your spouse, guess what? You need to invest in that relationship. We call them deposits. Me and Britt always call them deposits. If I feel like I am not clicking with my kids, then you want to know why? It's because I need to put some deposits in. I need to invest more time into that relationship with my kids. It's the same thing with anything that you're doing, man. If you're trying to raise capital, the way to do that, the way to get a return from those things and build your investor base is investment in energy, time. It's work, right? To put it together. Is it worth it? Not even a question. Because as you build those relationships, your ability to take down deals grows. And then your ability to be more valuable grows, carve out more ownership grows. It's investment. So many people try to skip the investment portion for the return, meaning they think going to family office is easier because it's just one investor. And so they're going to skip this work of building relationships and go right to this big investor. Well, then your return is going to go down. So you need to invest in those relationships, invest in time in the business. It's not an overnight thing, man, but it's taking one step by step, right?
I think the important thing too is realizing, Tyler talks a lot, if you haven't watched the sales advanced training, watch it, right? He talks a lot about frame control. When we start dealing with big money, right? You start thinking that these, as Aisha or Lisa put it, billionaires or people with high net worth, right? They say they're putting the check in. Oh man, I've got to cater to them and what they want. I've got to do it. No, put your foot down, right? Have that strong frame control. With our Canadian investors, we thought, man, we got nervous at first getting on the phone with them, man, because I don't know about you guys, but I'd never talked to a billionaire at that point. Man, this guy flew in a private jet all over the place. He had just gone to Mexico, got back to Canada, flew down to our property. And man, I was intimidated. Tyler was. He had to get in the car and pick him up from the airport.
If you guys don't know this story, I picked him up from the airport on their private jet in the car. Ryan, Lisa, Greg, they were at the apartment. And I'm now driving them in this car. Dad is freaking grilling me with questions. And I get lost on the way to the apartment. I know this area like the back of my hand. This is where the school is. This is where everyone likes to go eat and hang out. And then I have to pull over and type everything in my GPS to get to the apartment because I got lost. Not ideal. Not ideal.
There's a reason you rode in the car with him. He would have turned right back around if I was in the car, right back on the plane. Inappropriate conversation. So anyway, no, but in those discussions, we knew where we wanted to be and we knew what our worth was, right? And you have to remember what your worth is as far as control goes. Yeah. And I'll never forget that conversation. A lot of you have probably heard the story. But when we called him up and said, hey, listen, we're not going to use you as an investor. Oh my goodness. You talk about, Tyler said he talks about the frame control and flipping it, right? Throwing something at him that's going to, oh man, maybe I need to go watch it.
Busting the power
frame, right? And flip the script on him. And I kid you not, he did not know it was coming. This guy did not, oh my goodness. I've never heard him beg more, man. This guy, he was like, they call back, hey, we want to make this work. We want to make it work. Okay, we'll lower the preferred return. We'll lower the hurdles and the waterfalls. And at that point, we had made up our minds, And so just because you're dealing with family office or high net worth individuals, man, it is having frame control, Yeah, they're not used to it. And when you give it back to them, here's the thing, if your deal's a good deal, right, they want to do it. People want good returns.
And here's what's interesting. Now think about this. If you've invested time to grow your investor base and now you have options, I can syndicate this deal with my investors, or I can bring in a family office group, institutional money. Well, guess what that does? That gives you leverage. That gives you the ability to now have a strong frame. Because if we knew that the Canadians were our only option, our frame would have been, we wouldn't have had a frame. It would have been a frame of, please, dear God, invest in this deal because you're our only option. And I'm going to try to pretend like you're not, but you are, right? Like our frame is very weak. But if you spend the time to build your investors and grow and plant the seeds, then you know what happens? Your frame grows because your frame, the strength of your frame is rooted in truth, right? So time. Love is spelled Time. If you love your business, you spend time on your business. If you love your kids and your family, you spend time on your family, right? Spelled Time.
That's what Nina just said. Time is the most valuable thing you can give to anyone.
How to find a sponsor.
You don't want to listen to Nina's. Look at Nina's time. She's telling you about time.
Yeah, there we go. Most important thing. There we go. Most valuable thing. And then I agree with that. And then how to find a sponsor. There's a lot of ways to find a sponsor, but it's also time, right? It's getting connections. If first off, we have relationships with a bunch of different sponsors. We are sponsors, right? But it's funny. Somebody brought me or talked to me the other day. They're like, hey, I just want you to know, I was talking to a student, and the student said, do Tyler and Ryan really sponsor deals? Is that real? Like, do they really do that? Because I don't know if they, is that a true thing? And the student was like, well, yeah, they're sponsoring multiple deals right now. What do you mean? Yeah, but do they really sponsor deals, or is that just something that they talk about? And the student's like, what are you talking about? Of course they sponsor deals. What do you mean by that? Well, I don't know. I just don't know if it's fake or not. Well, okay. Why would they think it's fake, or why would they? Because they don't know how to find other sponsors. Maybe they brought us a deal and we passed to sponsor on that deal. I don't really know. It filters through Zach first anyway, because we had not even talked to the student about a deal. It filters through Zach first anyway. So maybe their perception of that, right, is Tyler and Ryan don't sponsor deals. We're literally sponsoring multiple deals as we speak right now. But we're one group, right? We're one group. Our capacity is limited, right? We want to give you access to a whole bunch of people. Our coaches in the office, do you know what they do all the time? Is what? Smile and dial. Call different sponsors, build relationships, see what those investors, see what those sponsors are looking for in terms of markets, in terms of deal size, in terms of all those kind of things, their net worth, their liquidity, what size they can sponsor. Our coaches are in there all the time, smiling and dialing to get those relationships and help you build those relationships. Well, you can do those same things. I mean, you can ask that. Summer's a great example of that, man. You can do those same types of things, but you can also get help. So many people just stay stuck, right? They stay stuck because the story that they tell themselves is there's no sponsors. And I know, Hamal, that's not what you were saying. I just had this experience just barely, so I wanted to bring it up. But man, let us introduce you to other people and meet people and get on, calls like this. But see who's on the call and reach out aside from the network, right? Private message, phone call, text, whatever. That's how you build your relationships, right? That's how it's getting involved and being active in it. Okay, last bit, deal component number 6, which is, really this is the fun part, which is the sponsorship fees, different ways that we get paid. Number 1, well, we'll cover these.
You should have taken it down and asked them to see, if they knew all of them. Now they know all of them.
Oops. Well, okay, hold on. Well, no, we're just going to put it up. These guys are slow typers. It would take us forever to do a quiz and see if they all get it. It's too long. Okay. Get your 5-way acquisition fee, guarantor fee, asset management fee, capital transaction fee, disposition fee. Okay. Let's explain what all these are, right? Acquisition fees. We talk about acquisition fees regularly. It's a very, very common fee that is paid to sponsors on the deal, right? It ranges from usually 3 to 5%. Most of the time we take 5, just as long as the deal makes sense for us to be able to take 5%.
It's on syndication.
Syndication, yeah.
Family office 1 to 2, institutional 0.5% to 1%.
Yeah. But listen, with the Canadians, that is one thing that we negotiated was 3% with them. So once again, everything's negotiable, but syndications, you're going to have just more flexibility there because you're bringing it in from multiple parties instead of just one. Your guarantor fee, right? What's the guarantor fee?
That's what you pay your sponsor. So that's typically 1% of the purchase price, or yeah. So that's what Tyler and I get when we sponsor deals.
Yeah. So people structure this multiple ways too, where sometimes people will structure it where the sponsor, if that's their only role, for example, they get a portion of the acquisition fee. Well, You can also structure it where there's an actual guarantor fee in there. So there's the acquisition fee there, and there's also the guarantor fee. And that can be, I've seen it structured two ways. 1%, typically 1%, but it's either 1% of the purchase price or it's 1% of the loan amount. I've seen it done both ways. Once again, just whatever makes sense on the deal. And if the deal supports that, and I'll tell you a creative way. Once again, as an example, Tropical Ridge, it's a property we call it Charbonneau. We rebranded it Tropical Ridge. We did this deal. We put this deal under contract in June, July, or so of 2020. Height of uncertainty. We were nervous that investors we thought that investors may be nervous to invest because of the height of uncertainty. It was also different where we were assuming the loan, and so we didn't have an interest-only period, which did affect some of the cash flow returns, but we were very confident in this deal. Well, one of the ways that we showed the confidence and getting creative with that is we explained to the investors that, hey, we take an acquisition fee on every deal. Any of you who have invested, you know this, but on this deal, there's no interest-only period. And, our investors, most of them are used to having an interest-only period. Well, that affects the cash flow. Well, I'm telling you, this is what our return projection is, and to help you understand how we don't take that lightly and how, it's our job to make sure that we get there regardless of what the circumstance is. To show that, we're going to take 1% of this, this acquisition fee that we get. We're putting 1% into a reserve account, is a little over $100,000 into a reserve account. That is going to stay in this reserve account and be paid out to you as investors if the cash flow, the profits on the property don't get you to your preferred return. Now, it will supplement it if the cash flow doesn't get you there. Now, if the cash flow does get you to that preferred return, then this 1%, this 100,000, whatever dollars, I think it's 103 grand or something like that, whatever is over here. Once we do get to that, then we will pay that out to us as sponsors for getting there, right? So it's this buffer here. But I'll tell you how that deal was structured: a 5% acquisition fee with a 1% sponsor fee. So it's really, if you think about that, that's 6%. But how we structured it creatively is we kept a percent into a reserve account to help investors feel secure, help investors understand that we want to make sure that they get to the returns. This is what we're willing to do to make sure that you do. Once again, that's beneficial on both sides, right? Acquisition fee, guarantor fee. Your asset management fee. We didn't learn about the asset management fee for a long time.
I think it was because, when we learned, it was more of, well, why would you charge your investors 1% to 2%? That's what you're getting out of the 30%. And that's what, we were taught at first, right? Is, why would you do that? And I look at it and go,
well, let me explain what asset management fee is just in case. Your asset management fee is 1% to 2% of the collected money, the effective gross income, the collected money from the property. It's the same as we pay our property management companies from that EGI, the effective gross income. It's the same with our asset management fee, those gross collected, profits. And it's usually 1% to 2% of that. Okay, now go.
Yeah, this is what I love about asset management fee, is in that first year, as you're stabilizing the property, right? You're not going to see a lot of cash flow, but this is a way that you can make cash flow, and why would you not do 2%? If the deal works at 2%, do 2%, but we weren't taught that. We were taught, why would you do that to your investors? You're getting 30% of the deal. You're getting that. No, I mean, investors want you to stay in touch with your property management companies. Lisa and I were on calls every single week with our property management company, especially during COVID. Pre-COVID, it was just once a month, now, I guess we're taking over property. It could be more than that, but typically it's about once a month pre-COVID. Now we want to make sure that everything's, going accordingly to our business plan. But think about this. If you got, I think our average asset management fee is about $2,500, something like that. But think about that, $2,500, you have 4 properties, that's 10 grand a month. That's a lot. That's a good paycheck right there, so that's what asset management fees do for you. But it's paid out monthly to you, not quarterly like distributions. It's paid out every single month.
And it allows you, once again, that's a way to help you. What's the benefit to investors? Well, man, when you're not working a 9-to-5 job along with your investment company, and it makes your focus a lot more precise, right? Single point focus on the properties. And how do we do that? Well, we have to supplement those returns. And even though we know in the beginning, maybe the cash flow doesn't come from, the profits don't come from the cash flow, we still need cash flow. So remember how things are usually paid. You have your income, then you have your expense line items, then you have your debt service, then you have your capital reserves, and then whatever is left over, we split. Okay, well, what if there's not a lot left over to split? Well, okay, this is an actual expense on the property before we even get down to profits there, right? We put it on every deal. It's usually 1% to 2%, and it's a beautiful thing. And I'll tell you what, I learned about that, put this into perspective. I was at church, and I was talking in the hallway, and I'm talking to some random guy that I see all the time, and he asked me what I do, and I go through a little basic elevator pitch, and then he tells me what he does, and then he talks about how they get paid, their asset management fee. And I was like, well, hold on. Asset management, what? Help me understand this, right? Because he was asking how we get paid, and I broke it down. And then he told me asset management fee is part of their breakdown. I was like, whoa, hold on, help me understand this. So this is from, once again, learning, and you can learn from anybody if you are open to understanding that you don't know it, that you don't know it all.
I think Lynn right there is a little shocked that you go to church. I see him right there.
Come
Cindy,
on.
look at
How spiritualist can
I
be,
don't
man.
know, man. You
Don't-
know?
No, he's not. He heard me talk. He heard me tell a story at an event one time. He came up and called me out about it. I remember.
Tyler goes to the drum roll on Sundays.
The drum roll. Stop it. I don't even know where to take that because I don't know if I should explain what that is.
No,
But
no,
anyway,
no.
Okay, capital transaction fee. This is less common, but it's not unheard of. If this would be due during a refinance, let's say that we were to refinance a property into a new debt piece and give investors their money back, whatever. We could get a capital transaction fee that's typically 1%. And why would that be the case? Well, anytime we do something like that, there's work that's involved, extra work that's involved. To refinance, putting this new loan together, all that kind of stuff. There's new work involved, and it's a benefit to the investors. They're getting their initial investment back. Who knows? We might not even take anything from that refinance except for a capital transaction fee. So anytime that there's new work into the property to help investors once again get more returns, better returns, initial investment back, there's fees paid, which comes in the disposition fee too. Disposition fee we charge on every property, and this is like your acquisition fee once we buy a property. A disposition fee is like an acquisition fee, but it's a disposition fee is a fee that you get paid once you sell a property. It's typically 1% of the exit price, right? 1% of the exit price once we sell a property. So that would mean once we sell a property, right, we would get the our portion of the equity, any catch up that we have, but we would also get this disposition fee, usually 1% of the exit price. Why? Because there's work involved with making sure that we get the deal and paperwork and everything involved to make sure that we exit that deal properly. Yep. There's our returns. And that's the components, man. Those are your components of deal structure, waterfall, capital stack, all the above. Now, I do want to touch on a couple things before we end, and I definitely want to open it up to some questions.
I do want to mention something on number 3, though. A lot of people will say this as you're underwriting a deal, asset management fees will say, hey, you don't see in the underwriting template, on our underwriting template, we have asset management fees in there by the management fees, right? But a lot of times when you go and look at your trailing report, your T12, right, you're not going to see acquisition fees in there. Why is that? Asset management fees. You're going to see the asset management fee below the NOI. So sometimes you won't see that. And why is that? Because you're going to base your property a lot of times off the NOI. Right? Oh. And so it'll be a below line item. So if you don't see the asset management fee from the seller, it's because they put it below line item is what we call it. So I make that, point that out.
Yeah, that's a great point.
So when you guys do your numbers, make sure the property management company puts that below line item.
So you can truly gauge it. Wow, that's awesome. All right, question the disposition fee. This is negotiated in the underwriting. So it's negotiations is a funny thing, right? I don't necessarily use the word negotiating. I use this is what we're going to structure. Like meaning we syndicate this deal. So I don't go out to my investors and say, hey, this is what we're thinking. What do you think? What I want to make? What's your thought? Do you think? Are you okay paying me all this shit? I would like it. Are you okay with it? We don't do that, right? We don't do that. It is we structure what makes sense on the deal, right? Meaning as we're underwriting the deal, does it make sense to put these things in? What's there? What's the business plan? But then we structure it, right? And then we send this business plan, this structure. Now we're going to go pitch that to investors. But we don't negotiate at this point. With a syndication, we don't negotiate. An investor comes back and maybe they don't want us to take an acquisition fee or a disposition fee. We don't change. And we're not angry that they don't want to pay that. We're not angry that it's not a fit at all. It is, I sincerely to my core want those investors to make whatever decision is best for them and their money and their investment, right? I'm not angry if what's best for us on this deal isn't what's best for them. That's okay. I want that, and I'll even refer, and Ryan can attest to this, we'll refer those investors to somewhere else that maybe has a different structure. But for ours, this is the structure for this deal. And if it's a fit, we'd love to have you on board. And if it's not, that's okay. Let's give you somewhere, or we can keep you, updated when we have a deal that fits whatever you're looking for there, right? But anyway.
It's important to know on this disposition fee as well that this is in your PPM when you talk to your SEC attorney. It's common, but some SEC attorneys may not put it in there. And so it's important to know that because if you go to sell the property and it's not in your operating agreement, right? Then what you have to do is you have to send out, what do they call it? You have to send out, not a resolution. It's a resolution letter that you have to send out to have them agree to pay you a disposition fee. What? It's like an addendum. It's like an addendum. It's an addendum.
Yeah, I think addendum. There's
a different legal name for it. But you have to send out an addendum on it to all of your investors to sign off that they're okay with paying you a disposition fee. So make sure as you do your operating agreement that there should be a list of fees there of what's being paid out, that's included. Yeah. Sometimes I'll leave it out.
That's it. So let's open it up to some questions. You can either do that verbally. I want to say one more thing though, because, just along this line of negotiations and how we structure, it's a lot easier to be confident going into a situation once you've structured multiple deals, right? It just is. And what's funny is a lot of people will look at us sometimes and just feel like we're naturally confident in whatever it is, because that's what we try to project, right? And especially in this example, this experience where we're teaching and we're doing this side of things, right? Sometimes whoever's teaching or on stage or whatever it is, you look at them as they just have everything put together. They know what's going on. They're confident as can be. That's just not the truth, man. That's just not the reality. Like, there's, no matter what stage you're at, in any way that you're growing and you're doing something that you haven't done before, there is this portion of doubt that's there, right? No matter what, if you're growing, you have doubt, period. That's natural. But I'll tell you the difference here, right? Confidence, literally what confidence means, it means with faith. That means with faith, which means confidence is projecting into the future the best case scenario. That's what it is. You're projecting into the future the best case scenario. Fear or lack of confidence, it's the opposite, or it's the negative side of faith, really, because what you're doing is you're projecting into the future the worst case scenario. And my advice is to always be cognizant of what you're projecting, because what you're putting out there is what you're going to get, right? If you're looking at the best case scenario, that, what that does, it gives you confidence. And I'll touch on, Ryan's comment of going to church. I don't know where, spirituality, where everyone's at, whatever it is. I believe in God. And no matter what you believe in, whether it's God, the universe, whatever, what I've realized is a lot of people feel like God doesn't exist in business transactions. I disagree with that. I believe, and being a parent has made me realize this, that I believe that I have a God that loves me and wants the best for me. And so what that does for me? It gives me hope. It gives me hope. And that allows me to project into the future the best case scenario. I believe that God is with me all the time. Whatever you believe in, my advice to you is to believe in something that gives you hope, right? And project the best case, not the worst case. And if you do that, you'll be more confident in any situation you go into. But it's also our job to choose and make decisions to go down that route. Anyway.
Do you think there's hope in me getting married again, Tyler?
I have hope in that situation.
Maybe there's hope.
Yes.
I don't know. Who knows?
I will in a second. All right, let's open it up to some questions. So you can either do that verbally or type it in, whatever you would like.
So Tyler, let's open their mics. I want to hear some voices.
I would love to hear some voices. I agree with that.
Video and voices. Oh boy, no, you covered it so well. They don't have questions.
Thank you for spending Saturday with us. We loved it so much. It was just so much fun. Thank you.
Thank you. Hey, congratulations on the closing, guys.
Yes.
It's been a month, 2 months now, right? A month and a half.
Month and a half. We're going there next week. We are taking some of our investors. We invited them all, but they're not all coming. But we're taking the investors there, and we're doing a tour of the property, and got a couple other properties we're taking a look at.
That's awesome.
Congratulations.
Congratulations, guys. Hey, if you have not worked with Cindy and Lynn, make sure you reach out to them, man. They are amazing.
Rock stars in the Phoenix area.
Yep, Arizona. So yeah, they're investing in Mississippi right now.
Yep.
So looking at the Oklahoma market. So make sure you reach out to them.
Yes.
Thank you.
Thank you, guys. You're awesome.
Thank you. Thank you guys for spending Saturday, man. It's fun to see you all's faces on here, man, for sure. Base, you're very welcome. Summer. Well, you didn't say thank you, Summer. You said congrats, Cindy, but you're welcome. I read that wrong, but you're welcome, and I love you. And also, yes, congrats, Cindy.
Thank you above. Thank you all for the
No.
support.
Rude. I said thank you at the top. You better reread.
I'm totally kidding. I love it.
Eric says, tell the snake story. Is Eric listening?
Donovan, look at Donovan.
Okay, Eric says, Michael Miller is in. Well, ask Eric about me and his wife.
Snake story.
That is funny.
Thank you.
Is there anyone on from Atlanta on this call?
Thank you, Donovan.
That's funny. I can tell you guys all Eric's stories. Oh boy.
All right, you let me know. Is there any other questions that anybody has? I want to make sure that we cover them. By the way, first off, we love the feedback that you guys give once we send those out.
Yeah.
And it helps us so much to know how to make it better for y'all. And a lot of y'all have asked for more time for questions, and so we're going to start doing that. Another thing that I loved is somebody said maybe even some breakout rooms after, so y'all can get to know each other. And we don't have a structure for that, but we think it's a great idea to be able to do that, and so we'll start to implement that stuff as well. Once again, those feedback forms do not go unlooked at, man. We need to know what is making sense for y'all and what would be better. We don't know it all, man.
I think classes, man. Classes like this. If there's classes that you guys have ideas on that you want us to teach on, let us know. We'd love to do that.
Yes.
I do have one question. Oh,
yeah.
This is Shantae in Orlando area, and I wanted to know if there's a minimum number of units to best start this structure. Because I know when it starts to get below maybe 100 units, it's not as feasible.
Well, I wouldn't say, we usually say 20 units plus, but really we look at, and you can piece together some smaller ones, but 50 units, 30 units plus, people pass up on those deals all the time. But dude, the last deal that we just closed was a 46 unit property.
Yeah, we've done 31, 34, 40, 46. And those have been some of our best returns.
Yep.
Fantastic. Thank you. That's very, very empowering. Okay.
Hey guys, this is Brad. I got a question for you. So we went over a lot of stuff today, and as I've gone through underwriting, I've realized that a lot of the things, a lot of levers that we can pull and adjustments that we can make in our underwriting have larger effects on either annual returns or our debt service or whatever. But of all the stuff that you went over today, if you could pick out, say, 2 things that you think would give us the biggest bang for our buck as far as making a deal a good deal, what do you think that would be?
2 things that we covered.
2 or 3. Yeah, because we covered like 30. It's drinking from a fire hose for some of the guys that haven't been doing it for a long time.
To make a deal a good deal. I mean, I love the pref return on it. I mean, I love the splits. I used to be uncertain about that, but it's proven that 7-8%, 2 different tiers has proven to bring investors in quicker.
So I would agree with that. So
Yeah.
this number one, this actual takeaway is the 2 investment tiers. Remember in fact, I'll even go there for you to make it a little easier for you to see. Where do we have that here? There we go. This common equity, the class B and B1, meaning B would be a higher investment amount. The example we gave was Summit. It's $250,000 investment gets you an 8% preferred return. And then class B1 is the lower investment of $100,000 gets a 7% preferred return. That will help you with your raise a ton because it inspires people, motivates people, these big investors to put more money into the deal. I agree. That's a takeaway I would take for sure.
So this is something we didn't spend a lot of time on, and you had mentioned it. But being creative, right, is like Tyler said on one of our deals we did, Tropical, is it's uncertain times, especially right now. And I could care less what your political stance is. I really don't care. But we know the capital gains could be going up, right? Corporate taxes could be going up. I mean, all that stuff, right? Being creative in what you do and how your returns go. Tyler came up with, putting some of our acquisition fee off to the side, right, to get investors in. Investors want to make sure you're going to work hard, that you're not just going to get all this money and run away, right? Yeah. The fact that Tyler came up with that and said, we'll put money off to the side, and put our efforts where our mouth is, right? It brought investors in super. I think we raised that money in a couple of days or something. I can't remember.
Fast.
It was super fast. But remember, it's being creative. We call it creative financing. You can call it whatever you want, right? But for me, that's a huge takeaway. All this other stuff is just logistic. Right? I mean, we could structure things different ways. I don't know if your question, Brad, is how do we bring investors in based off our underwriting quicker? But I would say be creative with bringing in, know what their objection is, and come up with a solution to their objection right out of the gates.
That's it. And that's what I would drill down on is how do we come up with that solution and that creative stuff. It's not just shooting off the hip. It's truly taking a second to flip the focus, right? View it from their perspective and determine what would their concerns be? And is there a way that we can structure this deal that makes sense on both sides? Makes sense on their side, but also makes sense on our side. Makes sense on our side, but also makes sense on their side that helps overcome the concerns. And what's interesting is you think about that, we charged an extra 1%, which we call the guarantor fee, 1% to help overcome their concern. But obviously that benefits us as long as that deal performs. So I don't know, you have to see it from their perspective. Does that answer your question at all, Brett? Is that what you're going for?
Yeah, absolutely. I appreciate you boiling it down a little bit in a little bit easier bite-sized chunk.
Oh, that's a great question.
It's always hard to pick out 1 or 2, right? You always throw out the toughest questions, man.
It's because you've taught me so well. So critical thinking.
That is awesome. Let's see.
I have a question about the length of time that you hold the property. You said 3 to 5 to 7 years. Is that the limit, or you can hold it longer, or?
So we determine how long we hold, right? And that can also change though, right? That can change. But as we're giving projections to our investors, there's 2 questions that your investors are going to ask. Mm-hmm. Almost every investor. Number 1 is, when do I get my money back? Number 2 is, are you investing into the deal as well? Number 1, when am I getting my money back? That's not. So first off, if we didn't give them an exit strategy, right? This structure for an exit strategy, and we just said, hey, no, we're just holding it indefinitely. I mean, that would be a concern to them. Right? They want to know when they're getting that money back. But number 2, that's how our loans are structured too, right? These senior debt loans, Fannie, Freddie, they're not 30-year terms. They're 3, 5, 7, 10-year terms. So it falls in line with that too. But for example, with, Cedars is an example, right? Cedars we projected that to be a 5-year hold, but it made sense to sell in year 2. So we're always re-evaluating that and trying to figure out what makes sense on the deal. And it's our job as the managing partners, right, to make the decisions when to exit or to hold longer if it makes sense for the deal.
Okay, thank you.
I love Sherry's question here. You heard her comment, man. Her head's spinning. Have you ever applied these strategies to mobile home parks? I would say this. The mobile home parks, talk to Eric Blackwell. He's done mobile home parks. He is awesome at that. But yeah, some of this is very similar strategies to mobile home parks. But I'll say this. So your head's spinning. Tyler and I, man, and different networks that we've been in over the years, man, we have had to read a lot, right? And think about reading versus someone explaining it. You can take it so many different ways, reading it somewhere else, right? And knowing how to apply it. And this is what's awesome. This is what starting up a company like this, I don't know if you feel the same way. There are so many things, and we've known Cindy them for a couple of years now, Cindy, her husband, Harding, but there's things that we didn't know, before that we had to go read or find it in different areas to where we're able now, all these things, putting it together and being able to do these classes and explain them to you. So man, Sharon, I can totally appreciate your head spinning. And so I hope that you can go back and watch the recordings or get the slides that come out on Monday and go over these again, because these are things that Tyler and I have had to learn on our own that, man, there's been some times I've cried, man. And I'm not going to lie, learning this stuff and going through it and applying it to where all these different areas we're able to teach you guys now.
Hey, but I want to mention that too. We try to cover as much as possible, but there's going to be things that you have to learn on your own too.
Yeah.
And my ask is that you come back and you let us know what you've learned. Because once again, man, I'll tell you, the more that we know, the more we realize we don't know. Hey, Daniel Haifa, I'm so glad you turned your video off, man, because you always come in with these sleeveless shirts, dude, with your freaking biceps blazing. It makes me feel like a little boy. So thank you for turning your camera off with those cut off sleeves, dude.
Haifa, we had your music on the other day in the office, man. I said we had to get Tyler said I was too bad in here, man. We had to put it on.
I'm trying to motivate, man. I'm trying to motivate.
I love it.
There we go. I did see one question here with from Beatrice. If an investor dies after an investment, what will be done?
Common question. Super common question.
Okay, so what's the answer?
So, it depends on how they have it set up. It's in a trust, that money would go into, wherever they have it designated, for their shares.
Yeah.
So
that's up to them. Those shares don't go away though. Those ownership shares don't go away. That's up to on their side. How do they have it structured, right?
Yeah. We always refer them back to an estate attorney, to get everything set up correctly.
But those shares are transferable at that point.
Well, Tyler lives in Hawaii. He has to buy Jordans and stuff, right? So
yeah. we're hoping investors pass away. We just take their shares. No. Kidding. Why did you exit Cedars in 2 years? Was it because it made loss? How was the deal, investors?
We were stupid,
How to do with investors and properties.
That cash on cash was sick, though. Huh? That was unreal.
That property we exited in 2 years because we weren't planning on selling. We had brokers that came up to us, and this is a good learning lesson too. Brokers who they had investing groups that went up to them and said, hey, this is what we're looking for. These are the types of deals we're looking for. Go see if you can find us some of these deals. And Cedars met that criteria for these guys. And so this broker came and tried to convince us to sell the property. And these investors offered a good chunk of money to buy the property, which gave us really, really, really good returns. Our investors, really, really good returns. And we were able to exceed, I think, man, year 5 or even year 5 returns for sure in year 2, right? So what we projected, we were able to exceed those in year 2. So if you think about that, if we're able to get those returns in year 2, well, now we take that money and we go reinvest. If we keep that in there, we could keep that in there, and that property was cash flow positive, would continue to grow. But the risk, you're still in that deal. There's this risk that maybe something happens where you don't. So now you've held it for longer, and maybe those returns don't necessarily get higher as far as the exit price goes. So it's just this weighing out of what makes most sense. And it made most sense on that property to sell. It was not because of a loss, though. That's for sure. That property was doing great.
I want to mention something about Cedars, though. This is interesting. We would talk about having frames with investors, but having frames when you sell a property too. If it's off market and you're getting rid of, we were offered $2.3 million at first, and we're like, it was good, but no, we know what it was worth. And then finally we said, listen, what would you sell for? 2.6. We didn't know if they would buy it at all, truthfully. Yeah. And they did, man. Our frame was stronger. And so, we sold at that. But, selling a property, you've got to look at, the book that we read all the time that you reference in the classes, Emerging Markets, cycles and stuff like that by Dave Lindahl.
Yeah.
So knowing cycles and where you're at in the cycles. So you guys do capital expenditure budgets or capital improvement budgets that you guys have. You've got to know where you're at in the capital improvement budget, how much money you have, because if you're depleting that budget, guess where the money has to go to fix up a property? It goes out of your operations. So you've got to know where your budget's at, how much money is in your account, what you're going to do over the next little bit. So if it makes sense to sell today to where your returns are, then great. You also have to look at the treasury. No, that's too much now. That's a different class. Anyway, when you look at rates going up and how that's going to work, right? You've got to determine, is it right to sell today or sell 3 years from now? And that's.
Well, hold on. What if you don't know?
You ask.
Yeah. And you know what though? Is there ever just this right answer? No. Here's the thing, then. Choice is a funny thing, right? Choice is a funny thing, but we have to. First off, we get help, right? We ask questions. What would you do? We do that all the time. So, but then you have to make a decision, right? You have to make a choice, and really understand that that's what your investors are trusting you to be able to do, is to make choices, right? And choices are imperative, because once we make a choice, then we can truly make a decision, make a choice, right? And move that direction. Then we can start getting, inspiration in other areas down that path. But if we don't, we stay rooted in indecision in any way, then we don't make any progress at all, right? At all. So you have to make a decision. Now, when you go to make that decision, though, ask questions, man, and get different opinions, but still you're going to get differing opinions. So then you still have to make an actual decision. But once again, that's what your investors are investing with you to be able to do, is make decisions. You want to know why? Because making decisions is challenging. And if you can make decisions confidently with faith, right, that's valuable to your investors for sure. So you got to make decisions.
Courtney's question is would you use the same model with pref returns at smaller investment amounts for those of us just starting out? We started, if you're referring to like pref returns.
Oh, the tiers.
The tiers, yeah.
Okay.
When we started out, it's just easier to do 7% or 8% as you're establishing your investors. Once you get more investors and you have options.
But I think she's talking about smaller investment amounts like the capital.
Oh, the capital, like 25 grand, 50 grand, or?
That's how I read that, right? So you're saying where our tiers were 250 and 100,000, would you suggest,
smaller amount?
Courtney, please make sure that we're saying this right, but would you suggest maybe going lower? Is that what you're saying, Courtney?
Yes, okay.
Sure. I mean, you could play that. In fact, the first one that we did, it was 150 and 100.
Yep.
You could do 100 and 150. You could do 50 and 150. But yeah, I mean, sure, try it out, right? It's all a test. We did it. I'll tell you the last time or the first time we did it at 150 and 100. But the $150,000 positions went like that fast. So we're like, shit, dude, if we would have upped that a little bit higher, we would have probably been even easier because people would have made that extra stretch. It's all a test. And so, but yeah, I'd be totally open to that.
Beatrice's answer our question. An investor asked me if it would be possible to get his money back if an emergency after 3 months. I'm going to say this. If it's 3 months, I would probably say this is probably not the right investment for you. If they're already thinking 3 months, if investors are asking to get their money back, I don't know. We have enough investors right now to where it
doesn't matter if you have enough investors.
Yeah.
It's a strong frame.
Yeah.
And once again, it is truly setting the precedence of what is best for them. Is it possible for them to go get their investment back after? Sure, they can go find another investor to replace their money, but I'm going to tell you that's a pain on all fronts. So, I mean, if somebody's asking me that, you just have this strong, frame of explanation of, well, okay, let me explain. Ryan, is it possible? Yeah, it's possible, but this isn't what you would consider a liquid investment. Like, this is a long-term investment. This investment is going to be in here for, let's say, the whole 5 years, for 5 years. So if you think that you're going to need those funds before 5 years, this wouldn't be your best investment. You would probably want to do something different. And what you're going to realize is when you set that and you're just clear and set like this precedence of what it is, and you're just upfront, you don't get nervous and trying to appeal to everyone like, well, I mean, if you need it back in 3 months, I'm sure I can find a way to, fine. We could probably make it work. I don't know. I mean, yeah, if you just are firm and be like, no, this isn't the best fit for you. This is what this is. You know what? They're probably going to invest anyway because they know that you're being upfront and clear with them, right?
I'll tell you this as a side one is, with investors, if you find needy investors from the very beginning, it's so easy to be like, no, I'm going to put them in. I've got to get that. I can tell you right now, needy investors, you do not want in your deals at all. You may think that you need that 100 grand or that 50 grand or whatever, find a different investor. I'm telling you from we've had 1 or 2 of them that I'm sure that we at the very, very beginning to put into deals. Everyone does it, but
it's this fine line, right? Some of those come down to needs. Some of those come down to there's just a question. It's literally just a question to see how you're going to respond to it. So
I'll tell you, Cindy just makes a comment here. Thank you for sharing your time and experience. You guys are rock stars. I'll tell you, the rock stars are people that grind through adversity, right? Of thinking that they're not going to get a deal. Because Cindy, I'll point you out. It's over a year before you got a deal, man. And it'd be easy to give up, man. Yep. It would be so easy to give up. And I see, man, just the light that you have and the excitement, bringing investors out, and now who you're going to change, inspire and influence after this. It's so easy to give up, and this is more Tyler's lane, but it's so easy to give up during adversity, and say this just doesn't work, or this program or this network doesn't work. And that's not the reality, right? It is pushing through. I just told Tyler, was it this morning or yesterday? Tyler's more than the mindset side of things. Me, I'm just a freaking lost cause. But anyway, no, it is, it's not that real estate doesn't work, man. It is mindset that gets you through all this stuff, man. Dallas has, a phenomenal mindset program with Tyler that they've done. It is that mindset that's going to push you guys to get into these deals, So
I love that. I totally agree with that. So yes, Cindy, you're very welcome, but thank you. And I freaking love seeing y'all on here, man, for sure. I love it. All right. Anybody else have questions before we wrap it up? All right. Hey, so good to see y'all for sure. I love it. Seriously, it's so for this kind of stuff. I freaking love seeing y'all's faces and working and doing what you're doing, still chiming in, man. I love it. So reach out. We'll make sure that Jackson, when is recording and slides, when do you think those will be available? I want to make sure.
Monday afternoon for sure. Monday morning, first thing, we'll get them edited and sent out for sure.
Let's say by Tuesday morning.
Okay, I love
Hey, before we end though, man, happy Mother's Day to all you. Happy Mother's Day to all you mothers, future mothers, dog moms, whatever you may be, right? Dogs are important. Big
absolutely.
Moms, whatever, right?
Who are you calling a mother?
Who you calling a mother? You mother.
Who said that?
You mother. Michael Miller.
I love you. No, happy mother, and those of you who have moms, make sure you take care of them. Tell them how much you love and appreciate them.
Yes.
So perfect.
I love it. Hey, happy Mother's Day. We'll see you soon.
All right,
Have
guys.
a great weekend.
Take care, everybody.
Thank you.
All right, good. Man, it's freaking fun to see everybody on here. On the chat, I got Amanda, got Christopher. Good to see you, Chris. Alan, we got Raphael. What's up, brother? Dennis Garza, thank you for the low volume shout out. Let me know what's going on. It's good to see your face as well. Jim Bone, always a pleasure. All right, dive into some of this, okay? So what we're going to learn, okay? I'm going to go through a quick review of the introductory sales process. So I'll jump out of your way. But the introductory sales process, have you guys seen the introduction to sales on the path? It's the SALES. Give me a thumbs up or a yes or a no if you've done that. No. Yes. Nice job, Frankie. Good to see you too. No. All right. I really want to get an understanding. Okay, so a few of you have seen it. Okay. So that helps. I want to get an understanding of where you're at so I know how much to go through. I'm going to go through that very briefly then, okay? And we're going to dive in deeper into some deeper principles. Along those same lines, as you're asking questions, something that will help me, okay? And when you're asking questions on here, because I want to make sure that I'm answering them, type the word question, right, in all capital letters, and then spell out your question. It'll help out a ton, okay? That way we can identify them. And then I got the team here too, right? So they'll start answering questions in the chat as well. And then they'll let me know if I miss anything so that we can answer them, right? And if we did miss something, we'll just do a copy paste or let us know so that we can answer them, right? I want to make sure that we go through and get everything answered as we do it. So what we're going to learn, right? So a quick review of the sales process. I'm going to teach you frame control, which that'll probably be the biggest, the biggest section that we go through is frame control, which we'll do right out the gates. Frame control is an instrument that we use, right, to package power and authority and strength and information and status. And when you understand, or you truly start to understand how to utilize frame control, it will benefit you in every interaction that you go into. Also, and I'll show you the 4 frames. Okay, there's essentially 4 frames that we use, how to combat those frames as well. Oren Klaff wrote a book called Pitch Anything, where he talks about those as well, which is very, very good. Any of y'all ever read Pitch Anything before? Nobody? All right. Hey, Jay, do you have your